markets at the same time as influencing what's happening in the market. So I think there was a pretty clear message that the sharp rise in yields that we had seen was adding to the tightening of financial conditions, and that's absolutely clear. But on the other hand, by just making those kinds of comments, they've caused something of a reversal, which may mean that financial conditions are now not tight enough to prompt the reduction in inflation that the Fed needs to see.
Ben Laidler earlier this morning was talking about how the Fed put is back in play. Does that seem reasonable to you?
No, not really. I think that's going a bit far. I don't think the Fed's trying expressly to support equity markets or financial markets more generally. It has an inflation goal that it needs to consider, and of course financial markets play into that, and particularly the state of financial conditions. There's so much uncertainty at the moment about the length of the pass-through and how quickly you'll see this affecting the real economy. But what we know is that the increase in interest rates and the tightening of financial conditions more generally that we've seen in the US has never happened before without a recession following it. So the Fed needs to be very, very cautious about just how much further it allows that to progress.
Although there seems to be a shift over the past, week, where people are thinking more realistically about surgical Fed cuts, what we are going to hear later today from Neil Dutta, or this idea that the Fed is back in play with respect to responding to weakness in the economy, responding to weakness in markets by becoming more accommodative. Do you think the bar has gotten lower just simply because there are more signs of weakness?
I'm not sure that. Do you mean the bar to rate cuts?
Yes.
Yeah, I'm not sure that it has. And in fact, I think that this experience, central banks generally haven't experienced this kind of inflation for decades. And I think it's been a real eye-opener, just how far inflation has risen, how far core inflation, wage growth have risen in particular. And I think actually that means that the bar now for rate cuts is much higher. I think central banks have had a bit of a shock, and they're going to really need to see very clear evidence that labour markets are loosening in particular before they'll feel comfortable cutting interest rates.
Jennifer, I think there is some confusion still with this second paragraph in a statement that the Federal Reserve put out a week ago, and this line specifically: the tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring and inflation. Just how fluid is an assessment like that? Is that already dated, given the move we've seen in the last week? Is that taken account of the move we've seen over the last 6 months? Jennifer, what is that in your view?
Yeah, it's a good point. And yeah, as I said, the Fed's influencing markets at the same time that it's speaking. So it does mean that these communications quite quickly become a bit dated. But it's worth remembering that a lot of debt is over long terms. So the pace at which businesses and households need to refinance is relatively slow, and that will increasingly, we'll see over the coming months, that households with 10-year fixed mortgages are going to need to start refinancing, and then we'll start to see the effects of previous increases in bond yields coming through. So it's not so much about day-to-day fluctuations as kind of averages over the past 6 months and the pace at which they're passing through. Certainly the day-to-day has an impact, but we must bear in mind that these these average rates are very important too.
I certainly don't want to ignore some of the progress we've made elsewhere, specifically in the labour market. It looks like we've gone through a real rebalancing. Jennifer, in your opinion, do you think we can take some comfort away from the data we've seen so far? Just the idea that wage growth is a little bit more subdued. We've still got this payrolls growth. We're still doing okay.
Yeah, that's right. In the US, I think that employment report was a real Goldilocks report, wasn't it? It's clear that there's some softening in the labour market. Wage growth is coming down in the way that the Fed would really want it to, but there's not a collapse. There's no sign of a collapse in the labour market, of a surge in unemployment rates. So this is just the soft landing, really, that the Fed was hoping for. I think the real caveat to that is that that's really always how these things start, and it may be that the next employment report and the one after that shows something more worrying, but fingers crossed for the time being.
Jennifer McKeown, Capital Economics. Looks like a soft landing until it's not. Neil Dutta from Renaissance Macro with this to say. We'll catch up with Neil a little bit later this morning. Lisa, top line for him, for the Fed: the labour market is no longer a reason to be hawkish, for the reasons we just described.
That is the reason why we maybe heard a shift in tone from Fed Chair Jay Powell. To get from that to surgical cuts, to get from that to, maybe the Fed seeing something that looks like a soft landing until it's not. is a distance. And that's actually what I want to hear from him. How do you know that the weakness that we're seeing in the labor market isn't just a normalization that's going to then plateau versus the beginning of a progression into weakness? The Fed doesn't want to go too far. Neil Kashkari is pushing against that idea that, you know, this is just the beginning of more pain that's starting to cascade. Is there anyone else, or is he alone? Neil Kashkari of the Minneapolis Federal Reserve joining us on this program in the studio here in New York in about 45 minutes' time. Look out for that conversation. Look out for this as well. Coming up very shortly, we'll catch up with our good friend, our colleague Guy Johnson over in Zurich, following the latest numbers from UBS. That conversation just around the corner. If you are just joining us, welcome to the program. Equity shaping up as follows on the S&P. Session lows now. We're negative by 0.4% on the S&P 500 following a 6-day winning streak on the S&P, a 7-day winning streak on the NASDAQ. In the bond market, yields up big time across the curve yesterday, particularly at the front end. This morning, a little bit lower. We're down 3 basis points. Your 10-year, 461.41.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
That's very encouraging to see that so quickly our clients are responding to our actions to stabilize Credit Suisse and to offer them the best of the combined organizations. Credit Suisse needed to be restructured, profoundly restructured. I'm comfortable that we can mitigate the painful part of the job, which is the social cost. But it's very necessary in order to create a business that is sustainable.
That restructuring is going to have a cost. That was the UBS CEO, Sergio Marti, speaking back in September. We can put a price on some of that in just a moment with Guy Johnson. Let's turn to the broader price action. On the S&P 500, equity futures shaping up as follows, pulling back down by 1/3%. Yields coming down 3 basis points on a 10-year, 461. We have to sit on this, Bramo. This is quite a turnaround from where we were a couple of weeks ago. It's a 40 basis point move. Can point to the data, Treasury funding, the Federal Reserve. Take your pick at the moment.
Well, this is the reason why I think a lot of people aren't really responding to 9 basis points up or down from here, because we've already moved 40 basis points, so 9 basis points looks basically stable. At this point, we're looking at the potential volatility. Honestly, I keep going back to the Treasury refunding agreement. I think that was really what keyed it off. And then this idea kind of edifying that move with weaker than expected economic data. There are other questions, of course. The Bank of Japan, what's going on over there, the idea of just investors getting more stability and having a better sense that maybe we've seen a peak. At this point, though, the lack of conviction right now in markets is incredibly high. I mean, honestly, that's all I can say. And that's the reason why coming up with a narrative on any given day.
Oh, so difficult.
Good luck. Have a good time.
You can predict the future and still get the market wrong. pull up that board again, get to the market board again, and look at the bottom of it. Do you know what stands out for me this morning? Crude back in the 70s, Bramo. You nailed it. 79 on WTI. Go back a month. Who's going to make that call that crude's going to be back in the 70s?
Usually crude prices spike after some sort of geopolitical risk. There were people at the very beginning of what transpired between Hamas and Israel that were talking about $100 a barrel oil, easily $150 a barrel. At this point, we don't even understand why that's not even on the table. Is it because of a lack of demand, or is this because people really are sanguine about the risks around what's going on in the Middle East? I would have a very difficult time believing the latter. The former is much more believable to me, that maybe demand is not coming in nearly as strong as people previously expected.
Interesting. Crude right now, 79.57. Let's talk about UBS. That stock right now is positive over in Swiss trading by about 3%. We can catch up with Guy Johnson over in Zurich. Guy, walk us through the good news, the bad news, but let's start with the good news. Are they getting those clients back after the debacle that took place in Swiss banking in the last 9 months?
They are, and we're getting stabilization, John, and I think that's really what the investment community was looking for from this set of numbers. This set of numbers has no comparison. This is the first quarter we've seen these two banks bang together, as a result of which you can't really compare it to any other quarter. The analysts don't really have a handle on their estimates, so any kind of comparison really difficult to do. So you kind of park that, and then you kind of look at what is happening under the hood, and they're making progress. We're seeing stabilization in terms of the client story. That is great news. That means that they can progress with the integration. They've kind of got everything on a more even keel. And that's now the big question, John, where we go from here. But we're not going to know that until February, when we get the full year numbers and we get Sergio Mossi unveiling the big kind of 3-year plan, the strategy that he is going to deliver at this bank. So this is a kind of bridge set of numbers. It tells us that they are making progress. It tells us that they're on track. They've stuck to their 2026 goals as well, which is quite a significant. And I think, to be honest, that's why the shares are rising in a down market today. Things are on track. This has the potential to deliver, and if it's on track, that's great news. But there are plenty of problems that lie ahead. They've still got a lot to navigate.
Guy, do we have a better sense of who they're keeping and who they're not, of how many of the staff of Credit Suisse are going to stay on as UBS employees?
This is one of the critical questions, Lisa. There is $500 million that's being set aside for key staff for retention payments to make sure that those people stick around, because you track it on a kind of daily basis. There's been this person, that person departing for other big banks. You've seen that kind of steady drip, drip, drip. They need to stabilize that. They need to have the key relationship managers in wealth, etc., sticking with this institution. So they're parking money to make sure that that does happen. That's one of the key areas that they do need to stabilize. If they're going to make progress from simply stabilizing the numbers to growing the numbers, those are the people that are going to do that. And they are making it very clear that they're going to have to pay up to make that happen.
There was some angst when this merger was originally announced, when the takeover was announced, that a lot of clients would previously have gone to both Credit Suisse and UBS to diversify their risks, and now are not going to just simply take all the funds that they had at Credit Suisse and put them at UBS with their other funds at UBS. Do we have any sense of how much that's coming to the fore, whether the diversification risk is a concern for institutions in the region?
I think, so I don't think we're quite there yet, but it is an issue. Certainly analysts are talking about it, certainly the bank are aware of it, that they are going to have to manage these different kind of pools, and how they manage that diversification process, I think, is going to be very difficult. You're absolutely right. People would see these two institutions as competitive and therefore as diversified. I think it's unclear at this point how that process is going to unfold. I think it's unclear at this point whether ultimately, therefore, the pot is smaller. But maybe it does get smaller, but then it grows. I think one of the key questions that I think analysts and clients, I think probably more clients actually, both corporate and wealth, are still asking themselves is, how distracted is this management team going to be by the process they're about to go through? Would I be better off at another institution while we go through this process? And again, we've got to stabilization. They've kind of hauled some of the money back in, but whether or not that money is still kind of figuring out whether or not it needs a better diversifier, whether it wants to stick with this institution as we go through this process, I think that remains unresolved. We've only just started this process. We're in the first innings. There's a long way to go. And I don't think, Lisa, to be honest, that the answer to that question is in any way clear at this point.
Guy, just to wrap things up and take a more continental, European, maybe even global view, after the events of the last 9 months, particularly in US banking, we've been talking for a while now about the prospect of more consolidation. We're still waiting for it. Guy, what does that look like in Europe at the moment?
I think it looks like a long way off, John. Europe still really struggles with an integrated financial services sector. The banking union, I've been doing this a really long time. You've been doing this for quite a while. We've been talking about this for a really long time. We're miles away from it. It is still a patchwork of banks, banking regulations. So I think it's really difficult. But Europe really needs it. Europe really relies on its banking sector. It doesn't have deep capital markets in the way that the United States does. So this was a consolidation that came out of a crisis. I think a consolidation process that is driven by a desire to create bigger cross-border banking within Europe is a much more difficult process. And regulators don't seem particularly, and governments don't seem to be particularly on board with it. I would say, actually, John, we're going in the other direction. Rather than a consolidated direction, cross-border, I'd say we're going in the other direction towards a more national model.
Interesting. Guy, thank you, sir. Enjoy Zurich. It's great to catch up as always. Guy Johnson, our good friend and colleague. Feels like we've been talking about these issues forever, as Guy pointed out, a long, long time.
And I'm glad that you brought it beyond just continental Europe, but also in the U.S., because we've been talking about this as well. And why aren't we going to see some sort of acceleration of consolidation, especially after March? It hasn't happened. How much is this the fiefdoms of different banks and sort of not wanting to disrupt that? And how much is just the regulatory hurdles? Because banking is such a lightning rod for different regulators and for different politicians.
Slews. It's been 54 minutes. You haven't mentioned it.
It was not that interesting.
It wasn't that interesting.
That's the truth. I mean, it showed that maybe the worst is behind us, actually.
Okay.
If anything, it was actually more positive than a lot of people were expecting, and it was backward-looking, and suddenly the slews don't matter again. So congratulations.
This is the Senior Loan Officer Opinion Survey?
Yes, correct.
Okay.
Good job.
I mean, I tried to remember that 9 months ago and then just forgot it all again because we stopped looking at it.
That's exactly it. I mean, this was supposed to be the crisis moment. Something was supposed to break. It didn't. How much of this is because of the Fed backstop? We don't know. A pretty significant part of it. But we're not seeing the consolidation. We're not seeing the structural changes. We're just seeing the Band-Aids kind of over the edges so it doesn't have to percolate out too significantly.
Let's promo our next guest, Katie Kaminsky, Alpha Simplex. Katie Kaminsky short treasuries through most of this year. Short treasuries. And every time we backed away from new highs for the year, I'd turn around and say, Katie, you're still short. And Katie would say, still short, looking for high yields. We've just had a 40 basis point move off the high, through 5% on a 10-year, back down to the 450s, 460-ish right now. Is Katie Kaminsky still short treasuries?
That's exactly the question I want to ask her. And also, is there some kind of momentum trade in the volatility, the whipsaw action that we've seen, or is it too noisy to follow the kind of trends that she's known for doing?
That conversation 5 minutes away. Katie Kaminsky of Alpha Simplex. If you're just joining us, equity futures on the S&P, negative by about 1/3 of 1%. The bulls have been spoiled over the last week. 6 days of gains on the S&P 500, 7 on the Nasdaq 100. Bonds with a rally a bit, yields lower by 3 basis points. Your 10-year, 461.62. From New York City this morning, good morning.
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees, I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard, and if you don't give up, hopefully you find a way.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to
be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
There's a little shift underway here that I think we want to be mindful of.
We could see some positive action through the end of the year.
The heightened macro uncertainty means that investors do need to be nimble.
We don't think we're getting any more rate hikes from the Fed.
It's far too early to be talking about easing, so just beware of that sting in the tail.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a tone shift in the last week. Just amazing to see. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow. Your equity market this morning, negative 1/3% over the last week. Gains, 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 day after day. 6 days of it on the S&P 500. Bramo, 7 days of it on the NASDAQ 100.
And we were talking yesterday, is this real? And people were saying it really depends on what happens to the yield space. I've got to say, a tone shift, yes. But every guest who's come on set with us pretty much either rolls their eyes or looks exhausted, because there's no sort of clear sense unless you have a conviction that comes true of what exactly is behind some of these moves and how durable they are. It is difficult to come up with a narrative behind the strength, because it will be a narrative that'll get disproven within a day.
Well, the consensus view right now is the Fed is done. Rick Reeder at BlackRock, the Fed is done. Even Andrew Honorhorst of Citi says the Fed is done. Renmax Neil Dutta says we can discuss surgical rate cuts. We'll catch up with Neil later this hour. I love the tweets, the posts on X, call them whatever you want. This one here, the odds of an alien tea party in our backyard are as sensible as expecting a rate hike. That was Momentum Delta on X a moment ago.
All right, so there has definitely been a mood shift when it comes to the Fed rate hikes. There is a question, though, of whether we go full Ben Liedler and talk about a Fed put back in play, and the idea of the Fed is sort of the insurance policy against a hard landing. I don't know that we can go to that level. There still is a lot to be seen. CPI, for example, which we're going to get in the next couple of weeks. All of the data on inflation, what I'm looking at when I look at these companies, they're passing through a lot of the costs, especially when you look at Starbucks and when you look at Big Macs and when you look at all of these basic things that people go out and buy. They're getting more expensive and people are still paying. So at a certain point, you have to wonder, how much is the Fed still worried about inflation, even if the market seems to have moved on?
It's frustrating, isn't it? But the Federal Reserve and economists will come on this program and they'll tell you, yeah, but the rate at things that are getting more expensive is less than it was a year ago, and that's good. And people are sitting at home. And actually, I think President Cook, Governor Cook at the Federal Reserve, talked about this yesterday, something we've brought up on this program before. People are unhappy with this because they want 2019 prices. It's no good telling people that inflation, the rate of price change, is lower than it was last year. That doesn't mean anything to anyone. They want 2019 prices, and they're not coming back.
They're not going to get them. Disinflation is not the same thing as deflation. It's sort of this economics lesson that's not really making its way through the political sphere, because a lot of people are looking at inflation and they're seeing how much more prices have gone up, not the rate of inflation and whether the rate of inflation is coming down. There is a key question, though, about whether we are going to reach some sort of stasis in inflation. It's not even clear that we're not going to see a reacceleration in inflation. I think that that's what people are keying into when they take a look at just how much pricing power a lot of these companies have. And the companies are able to keep selling a greater volume at a higher price.
So let's reset. We've had a big move over the last week. We're going to catch up with Neil Kashkari of the Minneapolis Fed in about 27 minutes' time. Are there reasons for the Fed to be more tolerant of easing financial conditions, given what we've seen develop over the last week? Isn't that the question right now in this market?
It seems like maybe the Fed, if they're looking at data that shows a softening economy, that maybe they are more comfortable with it. That is really the takeaway, and it seems to be the theme that we're hearing under the hood from a lot of different investors. I don't think there's a consensus, though, on the Fed, and I think that's why it is interesting to hear all the different Fed speakers.
Kashkari, less than 30 minutes away. Look out for that conversation. Mike McKee's going to join us as well. Let's turn to the price action. Equity futures on the S&P 500 negative here by a third of 1%. A bond market rally this morning, a sell-off yesterday. I can't keep up. I don't know how you're keeping up. Yields are lower by a couple of basis points on a 10-year. Elisa, 461.83.
Or is it even worth keeping up? The Fed speakers are all keeping up, though, and they're all going to be speaking today. We were just talking about Neil Kashkari. We are going to speak with him in about a half an hour time. The other Fed speakers include Fed Governor Chris Waller, Vice Chair for Supervision Michael Barr, also Fed presidents from Chicago, Kansas City, New York, and Dallas. All of them maybe can give us more insight into whether we are seeing some sort of softening in the economy that justifies an easing in financial conditions. Neil Kashkari is going to push back on that, and we'll get his view in just a bit. 1 p.m., we get the U.S. Treasury selling $48 billion of three-year notes. This is going to be an interesting kickoff to the auctions later in the week of 10-year and 30-year notes. Really key to see whether the calm beneath the surface continues in the Treasury market, as really this is sort of tested in terms of how much demand there is for these notes. And today, it is election day. Local elections, as we were hearing earlier in the show. I'm really focused, though, on Virginia. If Glenn Youngkin, the governor there, can flip the Senate of the state to the GOP, there's going to be calls for him to run for the presidential election. Other people are going to say, as Mohammed Yunus did, that's a stretch. And yet there's so many articles pleading for him to run, essentially, and people in the industry, it gives you a sense of just how popular the current election as it's setting up is really right now.
Some British sarcasm there, Bramo. That works. Well, I appreciate that. We've got 6 months of this, haven't we? At least.
We're lining up. I mean, so many people are so unhappy with the lineup as it seems to be. And yet, is there any real discussion about how it is going to potentially change? Unclear. And that's the reason why I think it is important to watch this.
AMH, about 10 minutes away. We'll catch up with Anne-Marie down in Washington, D.C. in a moment. Joining us now, Katie Kaminsky, Chief Research Strategist over at Alpha Simplex. Katie, it's the #1 question for us. Are you still short treasuries?
Yes.
Why?
Well, this is because for trend following, it's not just about a couple of days. It's really about persistent trends in the market. And I just want to point out, and this is something interesting, trend following signals have been net short for 9 quarters. This is the first time in many decades that this has been the case. And so the reason I'm pausing right now is because we've been saying short, short, short all year. And for the first time, it's starting to feel like we already got that short come through. What's next? What does the market do? Now buyers are coming in because yields are at interesting levels. They're probably thinking, maybe we finally hit that point.
Do you think something changed fundamentally to lead to that in the last few weeks?
I do, and then I think that the data has come out to support the narrative for investors, but I also think a narrative that has made sense to me is that investors have woken up to the idea that 5% yields, at some point there's a buying point where you think, well, there's a chance this could actually go down, and now you start to see this equilibrium occur where you're seeing the disinverted curve, which is something we've been looking for since the beginning of the year.
So, Katie, just to put a bow on this, are you now not short treasuries and actually starting to see value, particularly if yields get up to that 5% level in the 10-year?
So we're still short in terms of the overall frequency that we see signals, but we are seeing consolidation in those signals. So there's a reduction in that particular conviction. But what I will say is that I'm seeing more and more positive signals on higher frequency. And so I think on the shorter term, you're going to see more and more potential buying for treasuries. But I do want to remind everyone, inflation is still an issue. Rates could be higher for longer, so there's still really a good chance that we're going to see a lot of this volatility instead of a new trend per se that starts to emerge yet.
This raises this question of which particular data points are going to be the real action drivers, like what we saw over the past 10 days. Is it going to be basically every inflation read that we get? Or do you really buy into this idea that it's Treasury supply that's been dictating a lot of the volumes and a lot of the angst that we felt over the past month?
It's really interesting that you bring this up, Lisa, because we've been talking about this supply issue. I mean, how often do people actually talk about supply? They're only talking about it because I think people are trying to understand the equilibrium of where people sit and what yield should cost. I mean, what should be the right yield? And I think from our side, on the technical side, what we're looking for is potential breakouts so that we're seeing a steeper curve at some point. Our view is it's going to depend on really what happens with the economic data of whether we end up with tighter conditions or if we actually see something very extreme where we actually saw higher yields again. That to me seems very unlikely right now. But I think it's really a point to start watching every data point to see which direction the yield market is going to go or which direction the yields go, because it's definitely an inflection point for me.
Katie, we're going to catch up with Neil Kashkari in about 20 minutes' time. I think we're all looking forward to this conversation. There is this second paragraph in the statement that they put out last week on tighter financial conditions. It reads as follows. I'm sure you're familiar with it. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Could you still write that same sentence today after the move we've seen in the last week? What's that a judgment on? The movement we've seen in the last month, the last 6 months? What do you think it is?
Well, I think the challenge is these numbers come in at different frequencies. Last week, we had a massive buying, but this could also be somewhat of a relief rally given how much movement we've seen downward, especially in equities. And let's just be honest, like I said, at a 5%, yields started to get exciting. People said, oh, I better get in there. So I think there's really still, this could just be the tip of the beginning of understanding how serious financial conditions have changed, and if it's enough to actually warrant a point where we might actually have cuts at some point earlier than some would have thought, like myself, who's been very pessimistic about rate cuts.
Katie, do you have a decent understanding of the conditions that would lead to those cuts?
Well, usually in terms of this, I think we'd have to see pretty severe deterioration in financial conditions to see rate cuts, given the mandate of the Fed and the fact that the other factors they're really focused on have not come down to their target level. So the fact that inflation is sticky and the fact that we have a strong workforce and that we have all of these conditions putting us in a good place, they have been pretty clear that they're going to keep us higher for longer until we can sort that out. On the other hand, if we had some sort of very severe drawdown or deterioration in credit that was clear, I think that they would have to act. So that, to me, would be the situation where we would see those rate cuts, is if you saw something in the credit markets or something in terms of consumers really struggling that would cause them to actually react.
So the Fed put still exists, just at a much higher pain point.
I would say probably yes. I mean, I think it always exists somewhere, but it's definitely moved a lot compared to what we liked in 2019 and before.
Kelly, let's finish where we started. Given the uncertainty you now have about your position, why maintain the short? That's what I'm going to walk away from this conversation scratching my head about. Why maintain the short when it can be as expensive as it was on weeks like last week?
So this is the point of trend following. Systematic trading is about not double sort of using your emotion in the moment. And I think what works with trend following is following the data, and we just need more data to know the answer. And over longer periods of time, it turns out the market is actually quite good at giving us indications of where things are moving. And it's particularly short-term movements where they disagree, where you want to lean on your own gut, but you shouldn't, because that's what systematic trading is really about. It's about measuring and following the markets and allowing the markets to tell you what where we're going as opposed to sort of my own personal view, unfortunately.
Katie, thanks for the clarity on that point. Appreciate it. Katie Kaminsky there of Alpha Simplex. If you're just joining the program, welcome. On the S&P 500, negative here by 0.25%. Yield's a little bit lower by a couple of basis points, 462.66 on a 10-year. Let's call it 462.87 now, Bramo. Neil Kashkari, about 20 minutes away.
I want to hear what he has to say about this perception that seems to be trickling back to the market of the Fed put. It lives, it's alive, it's the Frankenstein of all things that were killed off, let's say, over the last couple of years. Does he like that, or is that counterproductive to the goal of the Fed right now?
We might find out in 20 minutes. Can I just say, if you want to read Neil Kashkari's stuff, and a lot of people complain about all the Fed speak through the year, and sometimes we do too.
Who could that be?
At the start of the year, he put out a blog about the 3 stages that he sees the Federal Reserve going through. Step 1, get rates up really quickly. Step 2, sit there and consider in a more careful, perhaps slower way, whether you have to do more. And then step 3, that's when you have conviction. Look around. Is inflation going back towards target? Can we reduce interest rates? That was a really useful guide for Fed policy through the whole year. And I wonder if we're at that point now where we're shifting from step 2 and getting closer to step 3.
We're also facing off with impatient markets that try to step over whatever kind of stage you're in and get to the next one. So it was very easy to see the pause after the hikes. It's harder to see what's on the other side of a pause.
Bramo, financial markets are like a child with a book.
Yes, I know.
Straight to the final chapter.
Yes, I know.
Maybe a little bit of the
that?
introduction.
Did
of
you?
course.
Yeah.
This is a market that wants to trade the recovery to a recession we haven't had yet.
It's true.
But,
I read the last page too, and I'm not proud of it. I mean, honestly.
I'm immensely proud of it.
You are?
Yeah.
Okay.
How many books of those do you remember? Come on.
Well, I mean, come on. I just kind of feel guilty.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special 1-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything.
The fraud was on behalf of the court. The court was the fraudster in this case. They made references to assets that were very valuable. This is a scam. And this is a case that should have never been brought, and it's a case that now should be dismissed.
The former President Donald Trump speaking to the press after testifying in his New York civil fraud trial. This all ahead of the 2024 elections, where a recent New York Times poll has the former president leading Joe Biden in 5 key swing states. Live from New York City, welcome to the program. Your equity market on the S&P 500 shaping up as follows. We're negative 0.25% on the S&P. Yields a little bit lower by a couple of basis points on a 10-year, 462.45. Moments away, Bramo, from a conversation with the Minneapolis Fed President Neil Kashkari.
To try to understand how the Fed feels about the easing in financial conditions that we've gotten since the Fed press conference with Chair Powell. Is this a problem? Does this set them back? Suddenly, the bond market isn't doing the work for them, and does this create an issue, or is it fine, as you've pointed out, John, because the economic data is softening to the extent where they are comfortable with easier financial conditions?
Great follow-on guest after this conversation too, Neil Dutta Renmack, who is basically asking that question you've alluded to, whether this Fed can be more tolerant of the easing of financial conditions we've seen over the last week. And they've eased big time, looking at equities, looking at bonds, fixed income, treasuries, credit, looking at foreign exchange as well, the dollar a little weaker.
So here's the conundrum that I think a lot of people are struggling with. On one hand, the stock market is not the economy. The stock market is the biggest companies that are doing really well. Smaller companies are not, and you can see that in the Russell 2000. So at what point are Fed officials taking their cues from some of the community meetings that they're having with business leaders that are telling them, we're really struggling between inflation and higher financing costs, and saying, okay, well, if things get easier, it's fine. But the big companies that have locked in some of those maturities are doing fantastically, and so you can go all in the stock market, even if you see a real concrete weakening in the real economy. And I think that's sort of the complexity that a lot of people are trying to wrap their heads around.
Don't we see stories like that right across the country right now?
Exactly, that's
you can
my point.
say to them, unemployment's still low. Look at the equity market, stocks are up. Look at the S&P 500. Look at select names, Apple, Tesla, Meta, Facebook, take your pick. Ask them how they feel about this economy. Doesn't reflect that, that's for sure.
And if you look at just the tangibles of what people are paying for groceries, of what small businesses are having to pay for salaries in addition to their fixed costs, it raises this question about whether their fate is being accurately reflected in the broad stock market, the S&P 500. And so, again, I just wonder if the Fed's going to listen more to that than the equity market. And in some ways, in a counterintuitive way, this speaks to Ben Lader's Fed put coming back into play, not because they want to rescue the stock market, but because they're responding to a different market, the economy, that looks very different.
Can you imagine how difficult it is to run a business right now? We used to have these problems in the restaurant business in my family for a long time. I can't imagine how much harder it is now, given how much more expensive things are at the moment.
I actually was speaking with a restaurant owner recently who's a friend of mine who was talking about how much more they have to pay, how much the fixed costs of food have gone up, that they need to get a greater number of people in, and that means they've got to pay the higher rents. So if business falls off at all, they have no safety net, and they can't borrow to offset that in the near term, even if business falls off for a couple of weeks, because they'll be hemorrhaging cash because the rates are too high. This is the kind of calculus going on Main Street, whatever you want to call it, that big businesses are not grappling with.
Joining us now to discuss, Bloomberg's Anne-Marie, our chief Washington correspondent down in D.C. AMH, let's start there. It's a national story. Is it a local issue when we face these elections a little bit later?
Well, absolutely. What you're seeing time and time again when you poll the American people, especially as polling has really ramped up because we have a presidential election next year, is that time and time again, the economy rates #1 on top of mind of American voters. And when it comes to the economy, and even though we are seeing good data when you look at what's going on in the jobs market, the fact of the matter is Americans are still concerned with inflation, the price of everyday consumer goods, grocery prices. You were just talking about what's going on at restaurants and the cost of those kinds of goods. That pushes up your bill when a family is dining out, either a single person, a family of 4. Everyone is feeling how much more expensive it is. So potentially you can see in some of these off-year elections, is there any sort of referendum against what is going on here in Washington? But of course, there's a lot of single issues that are also being fought on these ballots, abortion being one of them. In Ohio, there's going to actually be an initiative to enshrine abortion into the Constitution in Ohio, into their state constitution. So it's going to be interesting to see the results of this and what potentially they can tell us in terms of reading the tea leaves about next year's general election.
How much are you looking into what's happening in Virginia as a referendum and whether Glenn Youngkin will be the Republican nominee?
Well, Terry Haynes of Pangea Policy says ignore everything but what's going on in Virginia, because what happens in Virginia means it could potentially be a future Republican president. So there's a lot of discussions, and we've seen all the reports that donors are cozying up to Glenn Youngkin and begging him to jump into this 2024 presidential election. But he has this governorship in Virginia till 2026. Due to the law in Virginia, he cannot serve or run for 2 consecutive terms. So he would end at 2026, and it gives him the perfect timing to then launch a 2028 presidential run. And potentially that's the path he may take. But let's see what the results show this evening. He has worked really hard with local legislatures to make sure they try to keep the state delegates, the House of Delegates in Virginia, red, and to try to flip the Senate red. If he's able to turn Virginia red, that sets him up nicely for whatever path he wants to take for his higher political ambitions.
How much time is there left to change the ticket between President Biden and former President Trump, the presumed nominee for the Republicans?
I don't think there's an exact deadline, but it's getting very close in terms of, so if Glenn Youngkin were to jump in, he's not going to be on Wednesday's evening presidential debate in Miami, the Republican debate in Miami. That's tomorrow. So there is some leeway, but I would say by the end of the year, if he was to get in, he would need to make that decision ASAP for starting of next year. Because for many people in D.C., it feels too late. But when you speak to people outside the Beltway, they say there is still a path. It's a very odd election year, to say the least. The clip we just showed coming into this was a former president testifying at a civil trial in New York State. So there could be potentially these wild card or black swan moments.
And yet he's the leading candidate for the party. And at the same time, AMH, we have a sitting president who's running for a second term, who people are still questioning whether he will run at all. What does that say about his prospects of winning?
Well, it's going to come down to these key swing states, which is why people are concerned when they look at the New York Times Siena poll over the weekend, or they saw our Bloomberg News Morning Consult poll, which showed that Trump is winning in key states. You have to win these key states or you lose the Electoral College. There's one caveat, though, in that Siena New York Times poll, and that is the fact that these voters say that if Trump is convicted, say, on the January 6th related trial in Washington, D.C., this felony trial, then they would switch their vote to President Joe Biden, even though many believe that the current president is just too old. They're not feeling the effects of Bidenomics, which we see him trying to transition this week and tout like he was talking about Amtrak yesterday. But the fact of the matter is, if there is a conviction on this president, that is potentially going to change these poll numbers very quickly.
Hey, Mace, just quickly, Bidenomics, what does that mean to the electorate? What does that word mean?
Well, it's not polling well, Jonathan. And there was a Washington Post poll done a few months ago when what you saw is the majority of individuals that were asked about Bidenomics, they couldn't explain what it meant. They couldn't explain parts of the Inflation Reduction Act that this administration likes to tout. This administration, when they talk about Bidenomics, they really point to 3 key legislation they were able to get through. One, hard infrastructure, which used to be a joke under the former president. Every week used to be Infrastructure Week. And this is why Biden yesterday was touting it. I actually got it done. We are putting $16 billion into Amtrak. Why are our railroads in America not as good or up to speed as those you've seen around the world? And many people can attest them if you've taken a train in Switzerland or if you've taken a train in Japan. Then they'll point to the Chips and Science Act. Then they'll point to the Inflation Reduction Act, which goes heavy on climate change, tax credits for EVs. The issue is, when you have inflation that is still eating away at families' paychecks, this kind of stuff is just not landing.
Swiss trains getting so much love this morning. That's the second time already. AMH, thank you.
They're great.
They are great. I mean, they're pretty decent, aren't they? It's amazing.
I love trains. I want to love Amtrak.
I can plan a trip with a Swiss train a month out, and it can tell me which platform I'm going to leave from, and then if I get a connecting train, which platform that train's going to leave from, and it's going to leave exactly on time.
Perfectly on time, and it's clean, and
like
it's lovely.
Like a Swiss watch. It's
right,
a beautiful
exactly.
thing. All right. Neil Kashkari up next.
story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we could take away.
Bloomberg Television and Radio. Context changes everything.
Six-day winning streak on the S&P 500 could be coming to a close. Equity futures this morning slightly negative on the S&P 500, pulling back by 0.25%. 7 days on the Nasdaq. 7-day winning streak on the Nasdaq 100. We're down about 0.1% on a session so far. Into the bond market, 2-year, 10-year, 30-year, 10-year, 463.70. Yields aggressively lower last week, a little bit higher yesterday, and Bramo this morning just a touch lower on a 10-year maturity.
That basically is flat. That basically is no motion whatsoever. And just wait a second. At 1 p.m. we get those auctions, and maybe we'll get a new tone, a new narrative that we can lean into.
Can we talk about one single name
Please.
before we move on? From $47 billion to bankruptcy, WeWork. We mentioned this about 90 minutes ago. If there's a winner of ZERP, is it Adam Newman or is it Adam Newman? Wow.
There are so many great poster children, but he really does take the cake in terms of having a company built on philosophy that in the nuts and bolts is basically getting 10 to 20-year leases for properties at 750 buildings and then renting it out by the month. And suddenly the office market collapses. And that is what you're seeing today, especially at a time where I believe they've got $19 billion of debt and a valuation currently of assets of about $16 billion.
Amazing. Just amazing. Full coverage of that on Bloomberg TV and radio throughout this morning. This morning, Mike McKee, drum roll, fantastic guest around a table with us to talk about Fed policy.
Yes, and thank you very much, John, because we are pleased to welcome Neil Kashkari, the president of the Federal Reserve Bank of Minneapolis, to the table today. Thank you for coming in, making the trip all the way to New York, only for us, I'm sure.
Nothing else, Mike.
Nothing else. There would be nothing else this morning, and except for Bloomberg surveillance. You're kind of known as the guy who is the most hawkish. I don't want to characterize you exactly now, given how things have changed over the last couple of months, but you have left open the possibility of doing more. How much more would you think the economy might need? Are we talking about just that one leftover move from the dot plot in September? Or if you have to start raising again, do you have to go farther probably?
Well, first of all, it's great to see you. Thanks for having me. People are looking for certainty, and I wish I could give that certainty provided. There's been so much that's unusual about the reopening of the economy and the dynamics that led to the high inflation and how long it has taken and the dynamics as the disinflation process has taken hold. I wish I knew. We have to let the inflation data guide us, the labor market data guide us. You know, just to point out the obvious, our forecasts have not been great over the past couple of years. And so we just need to, we're all committed. Everybody on the FOMC is committed that 2% is our inflation target. We have to get inflation back down to 2% over a reasonable period of time. Ultimately, the economy will tell us how much is needed to get there. And I just don't know.
Well, at what point do you think you would believe you have tightened enough or not tightened enough? What is it that you're looking for?
Well, I'll give you some good news, is that core PCE on a 3-month basis is running about 2.5%. And it's lower than the 6-month data, it's lower than the 1-year data. So that suggests that the disinflation is real. If we continue to see inflation numbers of that range, 2.5% or lower on a go-forward basis, that would tell me, okay, we are now on a path back to 2% inflation. But 3 months data is still only 3 months data. And if we see that start to tick back up again, that would tell me our job is not yet done.
Tick back up means what? In other words, we get another couple of CPI reports and a PCE report before your next meeting, a couple of tenths higher. The chairman and others say it's going to be lumpy, or does it have to be a significant move? In other words, what are you thinking about for December?
Well, I think we'd look at, as the chairman always says, we look at all of the data. So what surprises over the past few months? We've been surprised by how strong American consumers have been. Consumer spending has held up remarkably well. We've been surprised by GDP growth. When activity continues to run this hot, that makes me question, is policy as tight as we assume that it currently is? So if you saw inflation tick back up and you saw continued very strong economic activity on the real side of the economy, that would tell me, okay, we might need to do more. So it's hard for me to say this one data point needs to be here. I would be looking at the suite of data.
Did we outsource doing more to financial markets in the last week? Have we outsourced doing more to financial markets?
You know, this is a very complicated question on what has been driving the long end of the yield curve. Some people point to term premium, and I always joke that term premium is the economist version of dark matter. It's the residual of all the stuff we can't explain. It's not that our models are wrong, it's the dark matter is out there. So that's the term premium, and some people say, well, that's driven by fiscal. If it was fiscal driving the term premium, I would have expected to see a weak dollar. Usually when investors are worried about a country's fiscal position, their currency weakens. Our currency has been quite strong. It makes me wonder, is it really fiscal driving the term premium? Another possibility is the path of policy over the next few years. That could explain both the stronger dollar and the weaker stock market going into the last meeting. Another one is that maybe the neutral rate is higher, or maybe it's a combination of all three of these. And so these are things that we're spending a lot of time trying to understand what the markets are doing. But just speaking for myself, I'm not comfortable saying which of those three it is, because which of those three it is determines what it means for policy. If it is the term premium, then it is doing some work for the Fed. But if it's the neutral rate, or if it's the forward guidance of the path of policy, then we would actually have to follow through to preserve those rates.
So how did this line end up in the statement? And I'll share it with our audience. The tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Where's that coming from?
Well, that's been there for a long time. I mean, that's been in there since the Silicon Valley Bank episode and the banking stresses leading to some tightening of credit conditions across the economy. So I think that that's right. I, for one, don't say that that means the recent moves in the yield curve.
How fluid is that assessment? Can that change from month to month, meeting to meeting? Because some of those comments around that has inspired quite a move in this market over the last week.
Well, you know, one of the things about the statement, we always have to be careful about putting things into the statement because they tend to be long-lived, and it's hard to pull them out of the statement because as soon as you take something out, then all of a sudden people say, oh my gosh, they're declaring that all the banking stresses are over, as an example. And so, you know, I would look at all of the range of commentary that you get, look at what the chairman says, look at his press conference to get a read of the thoughts of the committee.
You said that people want certainty and that you can't give it to them, and I understand that. But people don't just want certainty. They also want some sort of guiding philosophy. Do you think that Fed Chair Powell has outlined some sort of guiding philosophy on where the bar is to cut rates, on where the bar is to raise them further?
Well, I think he's articulated very clearly that we're committed to getting back to 2% inflation, right? There's been some chatter amongst economists that maybe we should raise the inflation target. I think he's done a great job saying that is not on the table. We're not going to do that. We're going to get inflation back to 2%, and we're going to let the data guide us. We've moved very aggressively. We've made a lot of progress on inflation. We're not done yet, meaning inflation is not back to our target, and if we need to do more, we will.
There seemed to be a feeling in markets that the bar to cut rates has been lowered over the past week or 2 weeks, that suddenly not only are we reaching a pause and have we seen a peak in the Fed funds rate, but that also the Fed will cut next year, maybe surgically. Neil Dutta is talking about that, and he's coming up next. Do you want to push back against that? Do you think that the bar to cut is still just as high as it was?
I have no idea where market participants are getting that. There's no discussion amongst me and any of my colleagues about when we're going to start preparing to cut rates. The only thing that's been talked about at all is that at some point, when inflation is well on its way back down if we didn't back off a little bit, then real rates would be getting tighter and tighter and tighter. And that's real, but that's math.
But is there enough weakness currently in the market, in the economy, I should say, to give you that sense at this point?
Look at the last GDP print. I mean, does anybody look at that and think, oh my gosh, the economy, for the last 12 months, GDP has been very strong. The labor market continues to be quite robust. Yes, the unemployment rate has ticked up to 3.9%, but we've also seen a huge surge of labor supply, which is really positive, come online. So I'm looking at this, I'm seeing consumers that are strong. By the way, my airplane that I came here on was 100% full yesterday. It's going to be 100% full today. I'm not seeing a lot of evidence that the economy is weakening.
Well, whether you go higher or not, you are on board for longer. And so you must have modeled out some idea of how long you would need to leave rates unchanged before you could get down to a level low enough that you could take your foot off the brake a little bit. How long do you think you'll be at 5.5 into 2024?
Well, I think it's going to depend. If we continue to see inflation prints similar to the ones we've seen the last few months, you know, and we end up with a year over year at 2.5% core inflation, and it continues to trend down, that constellation would give me evidence to say, hey, we ought to look at, should we start backing off, just so the real policy isn't getting tighter and tighter and tighter, because we're clearly on our way back down to 2%. But again, I don't want to just point to one data series. We will be looking at the suite of data to try to get a read of where the economy is headed.
Well, not just data. You talk to businesses in your district all the time. What are they telling you now about their view of growth and hiring and pricing going forward?
It's moderating. So the labor market is still tight in my district. People, especially in the Dakotas, really have a hard time finding workers. But in Minnesota, it's still a tight labor market, but it's not as tight as it was 6 months ago. It's not as tight as it was a year ago. So that kind of maps to the national data that we're seeing of a gently cooling labor market, but one that's still very, very warm. Same thing with economic activity. Depending on the sector, they're saying, hey, we feel pretty good about things. We're a little cautious about the future. Obviously, they watch the news. They read the news. There's a lot of economic anxiety that is reported on that people factor that into their own thinking and their own business planning. So I think the outlooks are still optimistic, but it's cautious optimism.
Well, are they still raising prices or think they need to?
So it's funny. They still, by and large, have some pricing power, more than they had before the pandemic, but not as much pricing power as they had 6 months or a year ago.
Can we finish on housing?
Sure.
In the space of 3 years, we've had record low interest rates and the highest rates in several decades. Is this housing market broken?
Well, I think since the pandemic, we have structurally underbuilt the number of units that we need to meet our growing population. And that's the factor. And that's really about regulation at the local level that are creating barriers to more supply coming in. The rate environment will settle out over time. But structurally, we have to actually bring a lot more supply online to meet Americans' needs.
You say over time, but it could be like 20, 30 years. I think this is the issue here. The legacy of this FOMC could well be a generation of people locked out of the housing market.
Why do you say that?
There could be a generation of people with 2-3% mortgages that never sell their home.
Yeah, I don't know. People end up needing to move. It's funny, when people don't sell their home because they're locked into a low mortgage, that's less supply, but that's also one less buyer. Most people who buy homes are leaving another home. And so that affects both the supply side and the demand side of the housing market. Which is
why I said a generation locked down, because I'm renting and can't buy. So I'm not selling anything. And that's the generation I'm talking about. That generation specifically. Are you concerned that could be the legacy of this FOMC?
No, I think the legacy of this FOMC is that we've dealt with the pandemic very aggressively. Then we were surprised by very high inflation, but then we moved very aggressively to bring the inflation back down.
I want to ask you about a story on the Bloomberg terminal today about all the financial CEOs from the U.S. over in Hong Kong sounding very dour and down about the prospects for the economy. They suggest that things are pretty fragile right now, both in the economy and the markets, given everything that's going on around the world and in the shadow banking system as well as theirs. How worried are you?
Well, I mean, we're always worried about things that can happen all around the world. We've got teams of people looking at different scenarios around the world. Ultimately, we have to focus on what we can control. Geopolitics, when Hamas attacked Israel, the first thing we thought of is what's it going to do to the oil market, what's it going to do to commodity prices. Remarkably, the response so far has been muted. But that's something we're obviously paying close attention to. But the broader geopolitical issues are just so far outside of our bounds of forecasting. We have a hard enough time forecasting inflation. Trying to forecast where geopolitics is going, we just have to focus on what we can control.
Oil prices dropped, Bramo. I mean, that's the crazy thing about the last month, isn't it?
It doesn't make any sense. And this is the reason why trying to get it right is just impossible. And then trying to get the idea of a Fed put and whether they're going to respond. I'm just saying, people are talking about that now. So,
People talking about it in the last few hours.
Yes,
this morning on this program. Neil, always a pleasure. Thank you,
for
sir.
having me.
Neil Kashkari, the Minneapolis Fed president, alongside Bloomberg's Mike McKee. If you are just joining us, this coverage is going to continue. We'll pick up on some of the comments from Neil and catch up with Renaissance Macro's Neil Dutter. Look out for that conversation in just a moment. Equity futures on the S&P 500 pulling back just a touch by 1/3% following a 6-day winning streak on the S&P 500, 7 days on the NASDAQ 100, the longest winning streak on the NASDAQ going back to January. Over that period, we've had a gain of more than 7%. Are we confusing bond market stability with the bond market rally? I don't know. We can talk about that too. Yields lower by a single basis point on a 10-year, 463.28 from New York City this morning. Good morning.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
We have to let the inflation data guide us, the labor market data guide us. Just to point out the obvious, our forecasts have not been great over the past couple of years. And so we just need to, we're all committed. Everybody on the FOMC is committed that 2% is our inflation target. We have to get inflation back down to 2% over a reasonable period of time. Ultimately, the economy will tell us how much is needed to get there. And I just don't know.
Neil Kashkari, moments ago, the Minneapolis Fed president on Fed policy. This conversation is going to continue in just a moment with Neil Dutter of Renaissance Macro. Before we get there, just to check in on some of the scores right now in financial markets. Equity futures a touch negative by 0.25% on the S&P. Yields a touch lower by a single basis point, 462.87. The dollar a little stronger against the euro, 106.83. That currency pair negative here, Lisa, by about 0.3%.
I thought it was interesting that Neil Kashkari was talking about the dollar and the strength there, sort of kind of raising doubts about this story that the yield increase was really due to the increase in the debt, increase in deficits, increase in anxiety around the U.S. political system. That was interesting to me, that normally you would see the dollar weaken, and the fact that we haven't makes him sort of question whether this is a supply-driven story. I might push back that the rest of the world looks even worse, so there is that sort of issue, but, this has been one of the big conundrums.
Given the position they're in, they cannot talk about rate cuts.
Yes.
They can't even imply that they're thinking about rate cuts, and that's the conversation we need to have right now with Neil Dutter, the head of U.S. Economic Research at Renaissance Macro. Neil, good morning to you.
Good morning.
Let's go straight there, because my IB was lighting up with messages from you. We're not thinking about tapering 2 months later. We're a long way from neutral, cutting a month later. What do you think is going on within the FOMC? Where do you think this is going?
Well, I think I agree that it doesn't pay much to forecast right now. It's important just to look at the data as it's coming to you. And so I do sympathize with that. But at the end of the day, I mean, the unemployment rate is up above the Fed's forecast for this year. And that's the first time that's happened since March of 2022. Now, you know, when you're in the thick of it, it's hard to know whether that represents the start of something much more onerous or whether it's just the normalization of the labor market. But I think for the Fed, I think the doves on the FOMC, and remember, you know, President Kashkari, tends to lean on the hawkish side of the consensus at the Fed. I think for the doves, they have all the ammunition they need to basically put the hawks in a casket, okay? I mean, I think that's the way I would think about it. I mean, you can point to the pickup in productivity and what that's done to unit labor costs. You can point to what Powell has said, right? I mean, when central bankers use proceed carefully, risk management, that's code for doing nothing. And, you know, finally, I mean, the employment report was probably understating payroll growth. That's my view. I mean, there was a lot of strike activity and so forth. But at the end of the day, average hourly earnings are running just over 3% at an annual rate over the last several months. So I don't think the hawks on the committee, frankly, can use the labor markets as a rationale to be hawkish anymore. So that is over. And so I think the doves can basically say that the labor markets have been rebalanced. And if they can say that, just implicitly, it means that the door is a little bit cracked open for a cut. And, you know, the point I'm making to you is, you know, Jay Powell, it wouldn't be the first time he basically, you know, flipped on a dime. I mean, we're a long way from neutral. I mean, a few months later, he's cutting rates. We're not even thinking about tapering or hiking. And then we're hiking and tapering basically in the same month. So, you know, to me, the fact that they're not talking about it is irrelevant. It's also in their SEP for next year. The question is whether
surgical cuts. What are surgical cuts?
Basically, a few cuts to stabilize the economy. I mean, I think the issue is the extent to which cutting quickly translates into rapid economic stabilization. So, I mean, as an example, I mean, let's see what happens with mortgage purchase demand over the next couple of weeks. We've seen mortgage rates basically come down to, what, like 7%?
Okay, wait, I'm trying to wrap my head around this. 6 months ago, you were talking about way more economic strength in the U.S. economy than people had expected. Now you're talking about strategic or surgical cuts by the Federal Reserve to stabilize the economy. Are you saying that they are warranted because the economy
No, I don't think that they are. I mean, part of the tension, Lisa, is that my job isn't to tell people what I think the Fed should do. My job is to try to get into their head and figure out what they will do. I mean, if I was there, I would probably be more hawkish than the consensus on the FOMC, but I'm not there.
Well, but does this mean that you think the consequence of surgical cuts to fortify the economy will be prolonged inflation?
Yes.
Okay, so then how do you sort of arrange around that? Sort of what is the inflation rate? How do you sort of lean into the rally that we've seen in the bond market and say, wait a second, you guys have gotten ahead of your skis based on the game theory that the Fed is playing and the way that they're likely to do surgical cuts?
I don't know that the bond market's getting ahead of itself. I think the bond market is sniffing out that the distribution of risks have changed. I don't know what the Fed may do next. I mean, that's what I think the bond market is doing, and I think bond market investors are right to do that because, as I say, you know, you think about it basically three prongs, right? The labor market, inflation, and then financial conditions. If the Fed can look at the labor market and say the labor markets are rebalanced, okay, that's check, done. You can't use that anymore as a reason to be hawkish. So, if anything, if the unemployment rate's now going up a little bit, the distribution of risks are that they would cut because the labor markets, and right, if the labor markets are thawing, that's going to give them increased confidence that inflation will thaw. And then finally, if that's the case, they're not going to be particularly concerned about the easing in financial conditions that you've seen since in the last week.
Which is what we've been talking about through this morning, whether they are going to tolerate the easing we've seen over the last week, and it feels like perhaps they will. Help me, work with me here. It feels like to me that you believe the world might have changed post-pandemic versus pre-pandemic. Do you sense that they still believe we're still in the same old world pre-pandemic?
I do. I mean, if you listen to someone like New York Fed President John Williams, even Chair Powell, I mean, there's quite a bit of reluctance to just say that, neutral rates are higher. I mean,
why do you think that is, Neil?
I don't know. I mean, I think that maybe in their mind, things haven't changed. I mean, you saw Powell talk about this at the press conference last week. I mean, if we get a pickup in potential growth, it's a temporary pickup in potential growth, then we'll go back down. So if you don't think that the world has fundamentally changed, then you're going to be more sort of cognizant of over-tightening risk, right? Like, so if the unemployment rate is starting to go up, you may have thought, well, maybe you overdid it. So you might be more willing to cut sooner as a result.
So are you more bullish on the U.S. economy, but also expect inflation to remain higher? And the Fed, when people look back, this will be considered a policy error that they weren't hawkish enough.
Yeah, I mean, I think that would be, that would be something I could be saying in 2025.
What would you point to if you had this conversation right now? And I would love to get you around the table next time I have a Fed official to work through some of these issues. But what would you point to
dangerous.
as the number one thing that indicates to you that the world has changed versus pre-pandemic, that ultimately they don't believe in? What would you point to?
Well, I mean, the first is just let's look at the obvious. I mean, you've done a lot, and yet the economy is still kind of hanging in there. I would say that things like household formation rates are running twice the rate they did after the financial crisis. I mean, to me, I think it's much easier to tell the story about why the post-financial crisis period was actually the anomaly than not. So I think we're actually going back to the old normal, more so than anything else. Obviously, you think about all those people during the financial crisis period, or the years after it, that were saving up for retirement. A lot of them have now since retired, and they're now dissaving, which is, implies higher neutral rates. You think about income inequality. It was something that we were talking about all throughout the 2010s. Well, it's coming down now. People at the lower end of the wage spectrum are seeing more rapid growth in their wages. You see more increased sort of union activity, and unions getting big wins for blue-collar workers. I mean, these are not things, and those folks have a much higher propensity to spend. And so I think it's not right, in my view, to say that things haven't changed. But if that's what the Fed believes, then you have to be recognizing what that implies for what they might do later. And so I think just because they're not talking about cuts now does not mean they won't be talking about cuts in 3-6 months. That should be within the realm of possibility. And I think the markets, frankly, I'm not willing to fight the move yet. I mean.
Okay. Neil, a clinic, as always. You know you're one of my faves. I think everyone knows that. Neil Dutter of Renaissance Macro. Neil, thank you. Real clinic, Ramo.
Yeah.
That's ultimately the dividing line right now. The Federal Reserve, some people sense, still believes in the old world, that we haven't seen a big change.
I'm thinking about the hawks in a casket, and it's a very visceral image.
I know, it's pretty brutal.
It's pretty brutal. Just thinking the dove sitting there laughing, I don't know if this is really the image.
Kashgari's waiting outside
I know,
for Dutter.
In fairness, he's going to be one of the people. Anyway, let's move on.
Equities negative on the S&P 500 by 0.25%. Joining us shortly, Alicia Levine of BNY Mellon. In your bond market, yields just a touch lower on a 10-year Treasury this morning. Your 10-year yield at the moment, 4.63. From New York, this is Bloomberg.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
To investors, everyone is still so bearish.
What we're seeing is a lot more focus on selectivity from our credit investors.
Doesn't look like inflation is sustainably slowing at this point.
What the market's telling you is that they're pricing some easing.
It's a matter of who's going to blink first. Is it the consumers or is it going to be the corporations?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a fantastic morning already on this program. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market's negative by 0.25% on the S&P, but the last 30 minutes perfectly captures the debate in financial markets. Fed officials say no rate cuts are coming. Then you get a guest in the market turning around and saying, what, Bramo? Rate cuts are coming.
Saying basically every time they tell you that something isn't going to happen 3 months later, well, guess what? And that sort of seems to be what the market is betting. The key question is, how much is this a reprisal of the Fed put? How much is this in response to true weakness in the economy versus it's getting inconvenient to have tight policy when people are starting to actually feel pain? Remember, we actually had this conversation a long time ago, and then the pain never happened, so we didn't actually have to test the resolve of Fed officials.
The story of two Neils. Neil Kashkari of the Minneapolis Federal Reserve in the last hour on this program basically wants to remain vigilant. The risk here is that you still underdo things, that ultimately you need to have conviction that inflation is going back to 2%. Neil Kashkari, I won't use his language. I'll read what he wrote a little bit earlier this week, that ultimately the labour market is no longer a reason to be hawkish.
And that's basically what you're seeing priced into the market. How long were you practicing A Tale of Two Neils? I was sitting there, yes, I can imagine.
That's couple of seconds,
I think that's really good.
It
was fantastic. It was really good. It's sort of the morning of two Neils and the views that really are polarizing markets. Look, I think that also setting up the day with Ben Laidler talking about, the Fed put is back, and that is your insurance policy if things go south. Is that kind of what you're feeling in broader equities right now?
That's the bullish view, the hopes and dreams of a bull. Ben Laidler, a little bit earlier on this morning. Here's the pushback. Gone through this a few times, worth doing again. Marko Kolanovic over at JP Morgan, falling bond yields. Dovish central banks, take your pick. Knee-jerk positive for equities in the short term, but ultimately the growth policy trade-off will remain challenging into year-end. That growth policy trade-off's important here. You've got a Federal Reserve that arguably stays on hold into year-end, and growth, given what we saw in 3Q, that's going to be slower than it was in the third quarter.
So could you get very little pain and a Fed still potentially cutting rates? I mean, I guess that's essentially what you're looking at from the bullish hopes and dreams is soft landing, immaculate disinflation, and a Fed that adjusts to a less restrictive kind of way because they don't need to do that much more. It is head spinning. What we can see right now is the Fed has no clue. They have no way of guiding people because they don't know. They are watching the data as everybody else. And markets are still tied to this idea that essentially the Fed will not hurt them too badly. And that seems to be where we are this morning.
The comfort.
Yes, exactly.
The warm embrace of Chairman Powell. Equity futures on the S&P 500. Keep it together.
There's
futures
so many
on the
images
S&P.
this morning.
Don't.
The casket of
Get rid of those.
crows
Get
or
rid of
hawks
those.
or whatever.
Get rid of those. Equities on the S&P, negative 0.2%. We are a little bit lower this morning. Yields a little bit lower as well. Down negative, off by about 2 basis points, 462.66. Tons of issuance this week. We'll talk about it all through the week from the Treasury. This has got to become a mainstream story, Bramo. We've got to do our best to make it one. All the issuance coming from Treasury, all the supply, $48 billion of 3-year notes today. Tomorrow, $40 billion of 10-year notes. The day after that, $24 billion of 30-year bonds. That is a lot of supply that's going to hit this market.
And we haven't talked about supply for decades. And the reason why we're talking about it right now is because if it is not digested well by markets and yields go up, then all of a sudden, it is more difficult for the U.S. to keep spending. And I think that that ends up in a political discussion because essentially interest payments in 2050 will equal something like 8% of total GDP if rates remain where they are. So if you start looking at that kind of math, it's really deeply uncomfortable politically versus people going back to lower rates, and then you can make this sustainable for a very long time.
I'm waiting for the day when the White House press secretary opens up the briefing with a yield on a 10-year.
It may happen.
You know?
Let's work toward that.
And then you get all these DC journalists trying to ask questions about the bond market. It could be a few years away. We'll see.
I think we should try to make that happen.
Who knows? Alicia Levine, Head of Investment Strategy and Equity Advisory Solutions at BNY Mellon, joins us around the table. Good to see you, Alicia, as always.
Great to be back following the two Neils.
The two Neils
The
and
two
Alicia.
Neils.
There we go. We've got a band. Have we opened the door for a year-end rally?
I think we have opened the door. There's clearly a market clearing price in the 10-year, and that's a little bit above 5%, and that's essentially, I think, where our ceiling is here. And you've seen trying to get above 5% comes down, bats down again. That's the market clearing price. That's where you get demand. And I think with that knowledge, you set up into a year-end rally. I will say this, I think the geopolitical risk out there is still somewhat, the left tail's growing, but ultimately, the fear and loathing in this market has been about supply and yields. And what we learned last week, the market clearing price is going to take care of that.
Pushback, 2 points. I mentioned Marko Klanovic over at JP Morgan. He's stressing, emphasizing the growth policy trade-off will remain challenging into year-end. Mike Wilson, Morgan Stanley, bearish all year. We find it difficult to get more excited about a year-end rally. What'd you say back to those guys?
So first of all, it's been impossible to project anything in this weird environment. Because even if you got inflation right, sticky on the way down, Fed hiking more than expected in the beginning of the year, we're still up 14% year to date on the S&P. So let's talk about how the disconnect between financial assets and actually what happened in the fundamentals. So I think it's very rare to have two very negative years in the equity market following each other. It can happen, but absent a calamity, it's likely not to happen. Those are known risks, right? The fact that we have tightening, that the loan officer survey shows tightening, further tightening, and it's been going on for 6 quarters, that's known. Like, all the problems out there are known. And so in a weird way, it's a tailwind because the sentiment really is quite negative still. So it's not that they're wrong, it makes intellectual sense. I feel at home with that. But we have to invest client money in the real world and not just talk about it. And in the end, if you were underweight equities this year because you feared a Fed-induced massive recession and massive unemployment, you didn't make the year.
We're talking about equities as though they're a monolith, and yet the Russell 2000 really underperforming. The KBW banking index really underperforming. There are these spots that are more sort of hinged to the real economy that are really struggling. When you see a year-end rally, is it those areas or is it your usual suspects that have been doing well all year?
So look, we're talking about large cap America for the most part, which essentially means the S&P. Yes, those small caps are most exposed to the rate cycle because of the refinancing cost and the need for debt to grow. So the further down you go on the cap scale, that's where the risk is. So that's why we've seen such divergence in assets. Having said that, to Neil Dutta's point, if the economy squeaks out here, there could be a massive rally in small caps because they've been decimated. I mean, the underperformance in small caps versus large caps this year is historic. And so that in itself is interesting because what we've seen, you turn the page, people tax loss sell into the year, it's the mutual funds in October, it's everybody else into the end of the year, and then you wind up with the reversion trade in January. So, I mean, it could be a great investing opportunity as well. It's not that we don't know that small caps are vulnerable. That's why they're priced this way today.
A lot of people are looking at the rally and saying it's because the rally in equities and saying it's because we found stability in bonds. Is it stability? And John was asking this earlier. Is it stability or was it a rally, right? I mean, which is the difference? Is it enough just to have yields kind of bouncing around in a range that's below 5% and above 4%? And even if it's a pretty broad range, it'll be okay.
So that's a great question. The difference between stability and the rally. That's a great question, Lisa. I love it.
I stole it from him.
Okay, excellent question.
It's not as good now.
Yes.
Carry on, Alicia.
So, look, I think the issue is the stability. What we've seen is this year, the volatility in the bond market, less so the volatility in the equity market, which I think hit 13 at one point, which is shocking on the VIX. But it's the volatility in the bond market that's driven some of the risk-off behavior. You get stability there, you get some sense of pricing, maybe a ceiling on the 10-year, let's call it maybe, okay? But I think the thought of 6-year yield, 6% yields seems less likely today than it did 2 weeks ago, and that's information, and that stabilizes the equity market.
Where do you want to be as that starts to evolve? So banks have started to do well. Consumer discretionary really beaten up over the last few months going into last week. Where do you want to be?
So I still think you have to be in large cap tech. Like large cap tech America is about growth without needing to borrow. So that's an important story. And that's part of the reason that this sector rallied so hard the first part of the year, because as the Fed was hiking, well, there's one group of companies that doesn't need to borrow, right? And they've got inherent growth and they've got a cycle coming up with AI. So you still have to be there. I like going into the sectors that are the most hated. It's often early to do that, but ultimately, there's always a reversion in the following year. People are going to dump the losers into the end of the year. We've all seen this story happen. And then I think you can get in front of it. I'd say that for the most part, we are overweight U.S. assets versus rest of world. There's a really, ACWI is 60% U.S., 40% rest of world. We don't do that, right? I mean, you have not gotten paid to be either in emerging markets or Europe. I'm sorry, Jonathan. Either for the last...
Not personal, don't worry.
The last 12 years or the last 30 years. We run data on this all the time. And while you can have great year or two of outperformance of rest of world assets, over time, long-term money, that's what we do. You're not paid being rest of world. So we're there because we need to be, but it's not really a diversification.
I remember when I first moved here about a decade ago, a guest came on the set and basically said on air, John, don't get me wrong, Europe's great for vacations, it's bad for investing. And that was basically the mantra for the next decade, and for what it was worth, I mean, it was probably the right approach.
How do you feel about being the ambassador for all investments in Europe? That people come on and they apologize to you.
I don't take it personally.
We're so sorry, but we don't
TK
like
TK still thinks I'm paid in sterling.
He still thinks that you live there.
How long I've lived here for. Can we finish on this?
Yes.
The legacy of zero interest rates. We work to go from a $47 billion valuation in 2019, well flagged, anticipated, but to learn this morning that it's gone bankrupt. Have we fully realized the pain associated with everything we got up to in this market 10 years ago?
The poster child. The poster child, when money is free, what you can create and your negative cash flow can sustain a business with ever-increasing valuations because money is free. U.S. government has the same problem, as you've talked about earlier in this segment. Last year, net interest costs were $200 billion. This year, $800 billion, right? Low interest rates allow for a lot of spending. And in a sense, every balance sheet looked like a private equity firm. Deficit spending because you could keep on funding it. That's over. So the WeWorks of the world will be getting clearly a valuation cut, and the refunding is going to be difficult. So the areas we're going to see, obviously, commercial real estate, but again, not a secret. We know that. That's why some of the small, medium-sized banks are, the balance sheets feel traumatized right now, and probably static. But that story's not completely done. I don't want to paint a picture that it's all perfect, but I think we know where the risks are.
Yeah, there's a difference between the opportunity into year-end and the idea that we just haven't had the great refinancing yet. I just don't think we have. We can sit here and say Fed funds is 5 point whatever, but can you sit here and say that many people are paying it? We talked with Neil Kashkari about people being locked out of the housing market, sitting on 2-3% mortgage rates. So much of this, Bramo, still hasn't come to the surface.
In fact, you can actually look at borrowing costs that have gone down for corporate America over the last 2 weeks.
So corporate America and households have the same balance sheet, which is they can finance their debt because everyone's got debt at 3 to 4%, and they're making 5.5% on their cash. That can continue for a while, and that's why we haven't had the recession.
Alicia, it was great. It's good to see you.
Great
Alicia
to see
Levine there of BNY Mellon. If you are just joining us, welcome to the program. The S&P 500 right now, negative 0.2%. Yields a little bit lower by 3 basis points, 461.41 on a 10-year Treasury. Lots of issuance still to come. The 10-year, I believe, is tomorrow, Lisa. $40 billion worth of 10-year notes just around the corner.
Some people were saying that yesterday's sell-off came because there was a slew of investment-grade issuance. And here is my question. We haven't seen that refinancing wave. If we get stability in Treasury yields and suddenly people start to borrow, then do we start to see how many WeWorks there are out there? Because right now, I have no clue, right? I mean, WeWork is its own story and philosophy and situation that now has 750 properties they've got to deal with. But there's a question of how many similar types of similar, I don't know, debacles are lining up down the road.
Adam Newman. I mean, come on.
He had a vision.
Isn't that, you know, if there's a bubble, buy it, you know that saying? And then get out, and he got out, didn't he? Except he was pushed out. That's what's amazing about the whole thing. I could talk about it all day. Greg Dacko of EY coming up a little bit later. Up next on this program, Henrietta Trays of Vader Partners.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
So you told your mother you'd like to go to Africa and see the chimpanzees, and what did she say?
Not the chimpanzees. I would have studied anything.
Well, what did your mother say to anything?
If you really want to do this, you're going to have to work really hard. And if you don't give up, hopefully you find a way.
It's DC FinTech Week, and Bloomberg is on site. Live from Washington, Kaylee Lyon speaks with Grayscale CEO Michael Sonnenschein and others. Tune in for a special 1-hour episode of Bloomberg Crypto. Bloomberg. Context changes everything.
Americans focus on the economy. The economy is king. It's not only king, it's king, queen, and bishop when it comes to picking a president here in the United States. And that's going to be a huge factor in where people place their votes in November 2024. But as you all know, we are light years ahead from where that is in terms of assessing where the economy is going to be then. And that's going to be the major factor.
12 months away. Mohammed Yunus, the editor-in-chief over at Gallup. If you want to watch the full conversation, you can on Bloomberg.com. Well worth a second look. Mohammed Yunus and Gallup putting out this recently, and I think it's well worth a read. The two major political parties remain unpopular in the United States, with 56% of Americans viewing the Republican Party unfavorably, 58% saying the same thing of the Democratic Party. But this line here, I think, is really important that they're talking about over at Gallup. 53% of Americans believe the Republican Party will do a better job of keeping the country prosperous over the next few years, whereas 39% choose the Democratic Party. That's a problem. for the White House into next year.
And that has been something that has been ongoing in terms of the perception of both parties. And there's one theory that, one party tends to govern when things are going well, and then the other one comes in when things are doing badly, and that's the offset that you get politically. But the real question to me is, what is the economic issue people are going to hinge on? Is it bringing down inflation? Is it going to be the debt? Is it going to be the international involvement or the local involvement? What exactly are people feeling if they still are getting raises at a significant proportion? And if you take a look at the overall economy, and Fed officials come on and say it's really strong. We just had Neil Kashkari come on and say he's not seeing weakness in this economy.
To be fair to Neil, we just had a quarter where we had GDP at close to 5%.
Exactly.
Who saw that coming?
But this is my point. And then people are saying the economy isn't strong and it's not going along. So what are people talking about when they're talking about the economy and economic strength?
They're talking about prices, and they're higher than where they were 4 years ago. You can't get away from it. You can talk about inflation. Maybe prices aren't climbing at the same rate as they were last year, but ultimately, if you're looking at your bills, you sit there and you assess things, and you think about things personally. Not CPI when we put it out and look at how Wall Street reacts to it. You think about things personally, and people feel things are a lot more expensive now than they were 4 years ago before the pandemic. That's the problem they've got.
And at this point, it's unclear what they can do to fix that unless time heals all and we get a real disinflation or deflation. I mean, disinflation might not cut it by next year.
And to Mohammed Yunus's point, the Fed can't project any of this. We can't forecast any of this 12 months out. So it makes it tremendously difficult to make any projections about the economy and about politics into next November. If you're just joining us, the equity market's slightly negative by 0.2% on the S&P 500. Bond yields a little bit lower by a couple of basis points, 4.62. Joining us now is Henrietta Trace, Economic Policy Research Director over at Vader Partners. Henrietta, let's just start with that poll that came out this weekend. New York Times, Siena College. Terrible reading for the sitting president. Are you expecting that to change anytime soon?
Well, what I really want to see is what the turnout in Virginia looks like and tells us where the polls are right and where they're wrong. One of the striking components of that New York Times Siena poll is that you're looking at a state like Nevada, which is historically very tight but reliably blue, and it suggests that pollsters are finding a 13-point swing away from Democrats and towards Republicans. I don't need to tell y'all, that is an enormous swing. Americans just don't change their minds like that. So to see that kind of swing is either an outlier, the polling is consistent with others that we've seen, but we're going to have a real opportunity to see whether that polling holds true in Virginia today, where there's House and Senate elections, and could potentially get Glenn Youngkin to decide whether or not he wants to jump into the Republican race and upend things even further. So I think we have something rare in D.C., which is like a real poll that we can watch in real time as an election.
All right, let's build on that, because people have been debating whether this is real, whether Glenn Youngkin truly wants to get into the running today or this year or this particular running cycle, or whether he's going to wait until after his 2026 term ends. Do you think that today's election truly could determine and push Glenn Youngkin into the race?
Absolutely. I don't think there's a lane for him in the first place. If anything, Nikki Haley has usurped that by her strong showing in New Hampshire. But the three remaining realistic Republican candidates, if we include Youngkin on that list, so DeSantis, Haley, and Youngkin, if you jumped in, are just light years behind Donald Trump. So I think that it would be smarter for him to wait until 2026, get in next time around. But this is a signal that maybe he has an outside chance to win. And if there's a red wave, he's going to ride it, I would assume, and try to bolster his national credibility and maybe even just get in advance of the next cycle. But all pollsters and all close prognosticators in Virginia are anticipating that it's a Democratic win tonight, particularly late in the day as the votes come in later on Election Day. So I don't expect Youngkin to get in. I don't think it makes a lot of sense. I don't think there's a lane for him, but it is something that could very well happen as if the results are a surprise today.
The fact that we're even talking about it highlights how people are not excited about a matchup, once again, of Trump versus Biden. Do you think that it's truly realistic that one of the candidates on Wednesday's stage will rise to the occasion and take the place of former President Trump, or do you think this is essentially what people are going to have, and this is what the landscape will look like next year?
This is what the landscape's going to look like. I mean, to say that there's a presidential candidate in all three first in the nation primaries running 31 points ahead of his next closest competitor is ridiculous on its face to think that it would be somehow a different outcome. So my expectation is firmly that it'll be Trump and Biden. And I think what you see in the polls right now is just discontent with both of them. And you have a huge chunk of independent voters and undecided voters who either won't participate or haven't decided or gotten comfortable with the idea that these are their only two options. There's still this holdout component.
Do Trump's legal issues matter?
I think what Trump's legal issues are doing is presenting him as very fiery and sort of engaged and excited, which is something that Biden notably lacks. That whole narrative about Biden being too old, despite the fact that the two men are just a couple years apart in age. I think what Trump is trying to do here is be combative, so it makes him look vibrant. And in that respect, it makes Biden look more lethargic, and that is probably the entire goal here. He's very likely to lose most of these 91 different counts, but the point is to present as aggressive and vivacious, and that's what he's doing.
I want to put together two stories. We've tried to do that over the last few weeks, Henrietta. The situation in the Middle East and Israel specifically. There is always going to be division within any party over a single issue. There will always be an extreme fringe to the left or to the right. I want to talk about things to the left. Henrietta, how do you think this president is going to handle some of the pushback that he's seen from within his own party to his support that he has offered Israel following the terrorist attacks that we all witnessed on screen in rather graphic, tragic ways in the last month?
Yeah, I mean, I think all eyes are on Antony Blinken right now, and, you know, certainly out there doing work across the entire region to try to at least stem what could be a massive escalation. I think the White House's position to strong-arm Israel behind closed doors has become increasingly more untenable, and they're going to have to go public with that. The atrocities are now seeping out into, I think, mainstream American news cycles, and they are atrocious on both sides. And I think voters on the left and on the right are having a really hard time with it. So my main question is, how long can Biden keep his anxiety or pressure system on Netanyahu in private, and when does it go public? And I think that's the next step here, and I wouldn't be surprised if that comes quickly. That's why they're trying to pass the government funding bill as fast as possible with aid to Israel, so that they can say, you know, this aid is going to be contingent on X, Y, and Z. Let's have a ceasefire. You've got to stop the atrocities.
Lots to talk about into the end of the year. Henrietta, thank you. Henrietta Trays there of Vader Partners. The pressure building, Lisa, we've been talking about it now for the last few weeks.
And a lot of the headlines now are talking about how the U.S. is getting frustrated in terms of how much influence it has over Israel, even as all of the warships and the submarine with nuclear capabilities head to the Mediterranean. A real question on how much the diplomacy efforts have really borne fruit. And then on a political sphere, whether it matters at home, whether they're bearing fruit at home. It is a very difficult moment.
This is so complex. We don't need another armchair general, that's for sure. This stuff is so difficult and complex to get your head around.
And deeply emotional and polarizing. And it is clear, and I think you're right to say, we are seeing divisions on the left that are coming to the fore that are really deeply challenging for President Biden, especially heading into this election with certain swing states. I'm thinking of Michigan in particular.
We'll turn the focus back to financial markets in the next hour. Coming up in the next hour on Bloomberg TV, Jack Caffrey, JP Morgan, Jim Caron, Morgan Stanley, Laurie Calvasina of RBC Capital Markets. All of that coming up and a whole lot more. If you are just joining us, your equity market is slightly negative. We're down 0.25% on the S&P 500. Haven't seen this for a while. We've had 6 days of gains on the S&P, 7 days of gains on the Nasdaq 100, and in the bond market, yields are way off the highs, the multi-year highs that we had a little look at a couple of weeks ago, down from 5% to 462.24 on a 10-year in America. From New York City, this is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
An hour into the opening bell, a little bit of softness across the board. Welcome back. This is Bloomberg Surveillance. John Farrow's off to start preparing for his next hour. Tom is off. He will be back tomorrow. And we are looking at a real dearth of economic activity so far this week. We're not getting a lot of data after last week's bang up 1, 2, 3 punch that sent yields plummeting by 40 basis points. They are still lower, 4.62%, just off about 2 basis points. And you're seeing a little bit of SOG on the equity indexes after a really robust 6 to 7 day rally, depending on the index, and a real question around how much we're seeing stocks and bonds reflect the soft landing scenario that a lot of Fed officials have been talking about. Earlier this morning, we did speak with the Fed president from Minneapolis, Neil Kashkari, and he was talking about the need to do more. Michael McKee here with us, Bloomberg International Economics and Policy correspondent, who has given up his sleaze mantle after it didn't come out with anything particularly interesting. Why are you here? What is so interesting on a day of no real data?
I heard you were here, and I thought I'd come say hello. We do have some data.
All right.
It's the September
Try to
trade
sell it.
figures. September trade balance, $61.5 billion, which is a little bit higher than the $58.7 billion that had been initially reported. So on the margin, a slight take away from GDP, but not really going to move the needle there. And basically at this point, it's a dull week, as you mentioned, for economics. We have jobless claims on Thursday, and that's about it. So everybody's looking to the Fed. And the interesting thing is we got 11 speakers this week from the Fed, 17 speeches or appearances, and almost none of them, with the possible exception of Jay Powell on Thursday, matter because they're not talking about monetary policy, which means that our interview with Neil Kashkari, this is a long way of saying our interview with Neil Kashkari does matter to the markets.
I think that it does, especially at a time where he is one of the few hawks that are kind of pushing back against this idea that the Fed is definitely done and that the Fed is complacent. We aren't seeing much of a reaction to the trade data that we just completely de-emphasized in advance of this, so it's not that surprising. But you do see 10-year yields still lower on the day. I do find it interesting, though, that people are starting to bake in rate cuts and basically say that the Fed has reached a point where they are comfortable with the degree of weakening in the economy. How much is that borne out by the data, that you truly have seen in last week's data a softening in the fundamental employment and other outlooks that would justify this kind of shift in narrative?
Well, you have seen a softening in the data. You look at the unemployment rate went up, and a lot of people are pointing to the Atlanta Fed GDP Now numbers because they have maybe one number or two to put into their calculations. It's kind of ridiculous, but it does show a drop-off in the economy so far, meaningless, but a drop-off. At the same time, the last CPI report, and we get another one next week, last CPI report on a month-over-month basis, prices went up. So they're still the Fed is still in this netherworld in between, demilitarized zone, whatever you want to call it, where they don't know which way it's going to go. And you characterize Neil as a hawk, and he's been a hawk, but now I think the definition is it's kind of hard to put a real label on people, because there are people who think we don't have to do anymore and probably won't. And there are people who think we don't have to do anymore, but maybe we will. And he falls in that latter category. He's not ready to give up yet, but he's not saying we need to raise rates again.
On one level, we don't have that much economic data this week. On another level, we have a lot. And that has to do with the auctions, $112 billion of Treasury auctions. How important will those be for Fed officials who are trying to understand where demand steps in and what kind of prices seem to be stable in markets at this point?
They'll watch with interest to see what the price is. The market's always clear. Neil and I were talking about that off camera. It's just a question of the price. And so what do people think they're going to have to pay to absorb all this paper? We're not just talking about $330 billion of treasuries. We're talking about $40 billion of corporates this week as well. So you got a lot of paper coming out that has to be bought by somebody. So what are they going to pay for that? But as you heard when Neil Kashkari was out here, the Fed doesn't think that fiscal issues are really what's driving the market. They have a day-to-day issue in the markets, but that it's probably more like the state of the economy and the state of where they think the Fed is going to go, short-term and long-term, with the neutral rate.
Michael McKee, thank you so much. And I did love Neil Kashkari's description of term premium as essentially the dark matter of economics, where it's everything else that we can't really explain. And parsing that out is something that is a feat of physics. Joining us now is a feat of physics, Greg Dako, chief economist at EY, here on set. And I want to start there, this question of, is the economy truly showing signs of softening to the degree that would support some of the moves that we've seen and this belief that the Fed is A, done, and B, poised for cuts as soon as next year?
Well, I think we are seeing some evidence that the economy is indeed slowing. The labor market has been the key pillar of resilience in the U.S. economy. We've started to see some softening. It's not the retrenchment that we typically see ahead of a recession, but it is evidence that employers are being more cautious with their hiring decisions. They're proceeding with some strategic resizing decisions, and importantly, they're optimizing wages. They're implementing essentially wage growth compression in an effort to limit cost. Because the key factor right now that's constraining the economy is this environment of cost fatigue. It's cost in terms of prices, in terms of wages, and in terms of interest rates. That is what is weighing down on the economy. The key question, though, is whether this continues and whether we continue to see this disinflationary momentum that would allow the Fed to hold put in terms of monetary policy and eventually start considering easing policy.
Do you believe in rate cuts next year? Does that make sense to you?
I do think there is the high probability of rate cuts next year. I think the key risk right now is that the Fed has, to some extent, delegated some of the tightening on the monetary policy front to financial markets. And in an environment where there is so much volatility in the data and where you remain extremely backward-looking in terms of your perspective for monetary policy, that's a key risk, because you're going to get these wild swings in terms of interest rates, as we've seen over the past couple of weeks. That's never good in terms of financial market stability. So I think what we need to see is more of a proactive and forward-looking perspective from the Fed to ensure that they take back the mantle in terms of guiding monetary policy and don't delegate that to financial markets.
All right, let's delve into that, because they have said higher for longer. What more can they say?
Well, they've said higher for longer, but they've also said that they're extremely data dependent. So one week it's all good because the data is showing that spending over the summer was very good. The next week, because there's a slower labor market print, all of a sudden we're going to be easing monetary policy, or at least that's the signal that they give. Fed Chair Powell was given the opportunity last week during the press conference to reaffirm the hawkish bias from the dot plot, essentially that additional rate hike that is in the dot plot for the end of this year. He backed away from that. He did not say that the Fed was still open to further tightening. He said that the dot plot would decay over a 3-month period and that they were not a promise. So essentially, instead of reaffirming this optionality, he maintained the window open but did not confirm this desire to tighten monetary policy further. I think there's a bit of an issue here because they're implementing tightening via financial market conditions. That's actually a new word in the statement. Right. Financial market conditions are tightening. And at the same time, they're still extremely backward-looking. That duality is very difficult to comprehend from a market's perspective.
So do you think that that was a policy error? And I keep asking this question just to try to understand whether it's justified economically, and so everyone's going to run with it, and it's not going to be a problem for the Fed, even if financial conditions ease, like we've seen.
Well, that's the issue, right? The argument was that financial markets were doing some of the Fed's work, right? That we had seen a very rapid ramp up in long-term interest rates. Everybody was trying to understand why we came to the term premium as a potential reason for that increase in long-term yields. And now we've seen a retracement of about 40, 50 basis points over the course of the last 10 days. Does that mean that the Fed now needs to do more? Or is there an argument to say that actually, no, the Fed has done enough and that markets are pricing rate cuts today? That's the paradox that we're facing today. A very difficult exercise to plan when you're thinking about Fed policy. And that uncertainty is hurting businesses. Business executives that we speak to are highlighting this level of uncertainty as to where interest rates are going to be. Where is the cost of capital going to be next year?
And this is something that definitely has been underpinning the stasis that we have seen in a lot of corporate borrowing that's starting to thaw as we do have a bit of a rally. We're speaking with Greg Dacko of EY, and I want to delve further into this question of where we're heading to. And this was the debate that we had with Neil Dutta as well as Neil Kashkari. Where are we cutting rates to? Are we going back to what we used to know back in 2019, or are we in a higher inflation kind of environment? Do you have any conviction one way or the other?
Well, I think we're undoubtedly in a higher cost of capital environment, and we're likely to remain in a higher cost of capital environment for the foreseeable future. We know that central banks took the elevator on the way up. They tightened very rapidly in the face of what was unprecedented inflation for the last 40 years. Now they're likely to take the escalator on the way down. I think what's important, beyond the fact that they're likely to go gradually because they don't want to relent until they've won that battle against inflation, is the fact that they're likely to settle at a higher rate than was the case during most of the pre-pandemic era. They're likely to settle in an environment where short-term rates are around 3%. That means that long-term rates are also going to be in that 3 to 4% or 3.5% to 4% range for the foreseeable future. That is a new world to which the business world needs to adapt. It means that there are still investment decisions that make sense, but there needs to be much more scrutiny towards investments that have the highest return and focusing on productivity growth. We're hearing a lot more from businesses, from our clients, that are talking about how to alleviate cost pressures in this high cost of capital environment. And the key avenue is increasing productivity growth. It's not just a tech-driven play, it's a broad-based play driving stronger productivity via innovation, via processes, and via just more efficient workforce.
I think of the avocado at Chipotle, where they cut an avocado in half by a robot and then scoop out the core, and then somebody else does the actual mashing, and it's try to increase productivity. To your point, this is the kind of stuff that people are doing.
Yeah, and some staying power in the labor market, less churn, is also another way to drive that productivity.
Just quickly, is this all basically saying that the Fed put is still there? It just will only be taken out of the closet when there is a little bit more pain, and you will see the Fed come in, cut rates, and support market valuations and corporate balance sheets.
Well, I think what's being priced in right now is this environment that is perfect, essentially a soft landing where monetary policy is gradually eased over the course of 2024 because we are in an environment where inflation is returning back to the 2% target, because economic activity is not plunging, not retrenching, and because the Fed decides that the real interest rate environment is the most important and they want to recalibrate that to a more neutral stance. That is the soft landing scenario. That's the Goldilocks scenario. There is a high probability that we don't end up with that scenario, either on the upside or on the downside, and that essentially this pricing that we're seeing today of 75 basis points to 100 basis points of rate cuts next year, starting in the middle of next year, actually won't materialize because there might be a lot of shift in terms of economic activity going forward.
Greg Dacko of EY, thank you so much for being with us. Good luck today on the election day when all of us who have kids in public school no longer have them in school because they do not have school today. If you are just joining the program, you can see the S&P a bit softer today after 6 straight days of gains, up down about 0.2%. Not a lot of drama, as my partner would say. We're looking at euro weakness, a bit of dollar strength after quite a bit of euro strength, sort of reprising a bit of value after a significant fall over 10-year yields, 4.62%, 6.183% to the third digit. Right now, Michael McKee, I'm looking at the University of Michigan Sentiment Survey. Which of these data points are going to matter most at a time where at one point an increase in inflation expectations, torpedoed all market valuations, and then no longer had any relevance.
Well, it's kind of funny because, as Greg was saying, the markets are very sensitive to economic data now, and that will move around a lot, their expectations as they come in. The Fed is definitely looking at inflation expectations both on a market basis and on a consumer basis. And so they are going to watch that, but they're going to want several months of it because both of the big consumer surveys have sort of their biases. I wouldn't call them flaws, but gas prices really move the Michigan survey, jobs really move the Conference Board survey. So if gas prices are going down, maybe we see a little drop in what the Michigan inflation expectations are. But if those things start to get embedded and stay at a higher level, then the Fed is going to put that in the box with higher CPI and be worried.
I'm so glad you brought up gasoline. Thank you so much, Michael McKee, and crude, because coming up, we're going to be speaking with Nadia Martin Wiggin of Svelland Capital on oil prices, on some of the tie-ups that we've seen in the shale patch and beyond, and a real question about what's next in an industry that had been left behind and suddenly is very much a hot trade. This is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Slice through the noise. Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
If we continue to see inflation numbers of that range, 2.5% or lower on a go-forward basis, that would tell me, okay, we are now on a path back to 2% inflation. But 3 months data is still only 3 months data. And if we see that start to tick back up again, that would tell me our job is not yet done.
That was Neil Kashkari, Minneapolis Fed president, speaking with us about an hour ago as he parsed through exactly what the deliberation process is at a time where nobody really knows where this economy is going. A bit of softness to the tape after a number of days of strength, a real rally last week. This week, sort of a rethinking around what exactly transpired, why yields went down 40 basis points on the heels of a trifecta of a number of weaker data points, a Fed that appears to be okay with being on hold, and less Treasury issuance on the long end of the curve. I want to take a look at a number of names that are moving ahead of the opening bell on the heels of earnings. UBS coming out. We were talking about this earlier with our own Guy Johnson. You can see those shares up about 3.2%. The focus being the consolidation efforts moving along, reaffirming some of the 2025 and 2026 goals, and talking about how it's going to bring the two units together while getting rid of about 2/3 of UBS's investment bank. Uber, this is kind of interesting. Shares lower now, 2.6% lower in pre-market trading. Before, they were actually up after giving a forecast that topped analysts' expectations, talking about everyone still going around and ride sharing, ride hailing, food delivery business still strong. I'm going to dig through this and try to understand exactly why shares are lower, especially given the fact that going forward, they seem to be consolidating a lot of the market share. This is one aspect that third quarter revenue came in well below Wall Street's expectations. And this one, D.R. Horton, those shares basically flat. But to me, worse than expected quarterly orders at this home builder operator, given the fact that mortgage rates are so high and it has been dampening demand. A lot of the focus today has been on potential geopolitical risks, or I should say over the past couple of weeks. And everyone's been pointing to oil prices. Why have they not gone up, given that there is a sort of existential risk and threat that seems to be escalating every single day in the Middle East? Joining us now to help us understand what exactly to look for, Nadia Martin-Wiggin, director at Svelland Capital. Nadia, I just want to start there. What do you make of the fact that we're seeing crude traded on the NYMEX below $80 a barrel again today, despite what's going on in Israel and in Gaza?
Hello, great to be on. I think what we saw last week is that Hezbollah and Iran, for right now, they're on the sidelines, right? They don't actually want to show an escalation of the war going on in Gaza right now. So that has taken off some of the risk premium. For the last 10 days, we've actually seen the implied volatility in the options market come down. So it's not even something that's happened just today. It's been for the last 10 days, that trend. I think in addition, when that premium, that initial shock goes away, as we saw was the case with the war in Ukraine by Russia, eventually, the market starts to think about how to work around that. And for example, we've seen that freight rates have gone much higher. And part of that is when you look at it, it's almost like a risk balancing that, okay, if we can't flow through the Suez, and we have to go around, then let's de-risk ourselves if things were to take longer. And we see that the freight market has actually priced that in as if they have to avoid the Suez, which they haven't had to do. So as a result, things have come down also in the oil market.
Okay, so let's take a step back for a second, Nadia. If you're looking at freight producers that are already coming up with alternate routes that avoid the Suez Canal to avoid potential, or the Straits of Hormuz, to avoid potential blowback from Iran, does this mean that oil prices are actually higher than where they would be at this point if there weren't this geopolitical overhang, because it's actually being priced into the market in a material way?
Yeah, if we look at what was happening to the market in oil before the October 7th attack, we could see that prices were coming off, right? We had a lot of pressure on refinery margins. We had physical crude trading poorly. We've had the largest overhang in the West African market that we've had in years. We had more than 25 million barrels unsold out of the November loading program. So we saw that kind of weakening. And then this is where the market would like to rebalance. And we saw the physical premiums come down for those grades, but the futures market has remained quite strong. And this is where we have to see that kind of rebalancing. When we look at kind of the momentum and what is happening to pure speculative traders, the CTAs and so forth, that short-term momentum has been downwards, right? And that has put pressure, bringing us down to where we are now in WTI, just above the 200-day moving average. If we look at that long-term momentum, it's still intact for a strong market, right? So there are still those longs in the market that we've had in since before all of this started. But again, the market is preparing in case something were to happen, because things had been ticking along well in the Middle East, and we were about to have a deal between Saudi Arabia, the US, and Israel, recognizing Israel, which would take off potentially a premium, right? And instead, we've moved in the opposite direction.
How much is the U.S. becoming the swing producer at a time where there is consolidation in the shale patch, and you are seeing companies try to realize the value from their stores, basically pump the oil while it's still valued in the world?
The deal of Exxon, for example, buying Pioneer, right? That really shows that they are focusing on the Permian, right? And what, interestingly, Exxon announced in their earnings call is that they believe that with their equipment and knowledge, they're able to bring in a total of 1 billion barrels of oil more out of those same assets than Pioneer was able to. So when we think about the terminal regular production rate in the US, that goes from around 14.5 million barrels per day to maybe 15.5 million barrels per day. And the question is, when do we reach that, right? August production was 13.1 million barrels per day. It will probably take 2 years, but of course that depends on the short-term oil price and the signals, short-term meaning monthly, quarterly, and the signals that yields to shale producers in terms of activity, right? A weaker oil price will slow that down. A stronger oil price will speed that up.
So right now, given where prices are, do you expect more consolidation to be expedited currently, or do you think that people are going to wait until prices go up a bit further?
Well, prices are reasonably strong, right? The whole oil complex is in a good situation and making money. So what we saw at the start of October is that demand was starting to get hit, right? We had producers selling crude for more than $100 a barrel, and then we saw, for example, companies like India really complaining. Part of that is because Russian crude has continued to flow, and we had price caps breached, right? So you were paying more than $60 a barrel, maybe you were paying $70 a barrel, and then on average facing more than $100 a barrel was becoming difficult. So I think we've been in a pretty comfortable space, in the $80 range for everyone to make money. So it makes it ripe for consolidation and valuable resources. We don't really need things to move much higher.
Do you think that, all things being equal, this is going to be the range for the foreseeable future just because of the pushes and the pulls that seem to be working in equilibrium?
From a technical level, yes, but of course things can suddenly change very quickly, both in the Middle East, towards a negative, towards a positive. So that can really shift things. And the number one thing to keep track of is that inventories were expected to draw quite steeply in the fourth quarter, and so far in October they only drew on land around 300,000 barrels per day. So the market is waiting for evidence that actually we have tightness led by these supply cuts and demand isn't waning. Whereas, on the other hand, if it continues waning, then we could see further falls in price.
Nadia Martin-Wiggin of Svelin Capital, thank you so much for being with us. And right now I'm just looking at gasoline prices in the United States, and they have fallen from a recent peak in September of 3.88 or $3.88 to $3.40. So a pretty significant drop despite some of the geopolitical pressures outside of just simply gasoline that also have the refinery aspect in the mix. We're looking at crude that has come off quite considerably so far this month, so far over the past month, despite some of the fears about what's going on overseas. Coming up at Bloomberg TV at noon Eastern, don't miss this. On the heels of earnings, Uber CEO Dara Khosrowshahi joining to talk about the outlook for ride sharing, the outlook for how much wages have to go up for some of those drivers, which has been a serious issue, and consolidating market share at a time where that seems to be the trend versus Lyft. Also a question, of course, about how much people are going to pay as prices continue to go up. Prices of Uber shares lower by about 3% ahead of the open. Outside of Uber, we're looking at a bit of softness as people recalibrate after 6 straight days of gains, although less softness than earlier. S&P futures lower by just about 0.1%. Euro weakness versus the dollar, and 10-year yields, wow, they are now dropping even more, down about 4 basis points, reversing some of the increase we saw yesterday. Again, based on the volatility we've seen recently, this is basically no motion. This is Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
A
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the celebrity beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went. Speaking about that,
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic, because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Live from New York City this morning. Good morning, good morning. 6 days of gains on the S&P 500. Equity futures this morning just a little bit lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Fed officials pouring cold water over rate cut talk. WeWork going from $47 billion to bankruptcy, and DeSantis getting a boost from Governor Kim Reynolds. We begin with the big issue. Too soon to declare victory.
The Fed is still a bit wary or cautious about declaring victory.
Victory on inflation.
Inflation is still high. Not where it needs to be yet.
The economy is extremely strong.
Still not slowing as much as the Fed would like.
Inflation has come down, but is it going to continue to decline?
Doesn't look like inflation is sustainably slowing at this point.
I think the Fed's done with rate hikes.
The payrolls report was picture perfect.
The Fed is going to be very reluctant to cut rates here.
The bar for cuts is also very high.
They are going to err on the side of keeping the funds rate higher than they should, for longer than they should.
I don't think we're out of the woods yet.
The Fed might find itself facing inflation that has come off the highs, but will remain too high.
We need 2 or 3 more months of data to see where the U.S. economy is headed.
Joining us now to discuss, Morgan Stanley's Jim Caron, JP Morgan's Jack Caffrey. Jim Caron, I'm going to use your language to start this conversation. From the big bad wolf to Goldilocks, just like that. Is it different this time?
Well, as I like to say, it's not different this time, but it's likely to be a lot more risky. I think one of the conversations that's being had in the markets right now is whether or not, we can declare victory on the Fed controlling inflation, and are they done cutting? Look, I think the Fed is done cutting. I apologize. I think the Fed is done hiking interest rates in this cycle. However, the one thing that I will bring up, though, is that they are looking at things through the lens of financial conditions, meaning that what Powell said last week week was that we need to see financial conditions to be perpetually tight. That's higher rates and lower equity prices in order for that to feed back into the economy to cool inflation. And unless we see that perpetual tightness that the financial assets are doing, so weaker equities, higher bond yields, they won't be happy. So I think that when Neil Kashkari comes out and starts talking about, potentially hiking rates or that they're not done, hiking at this moment, I think it's right on script because the Fed needs to keep the market on its back foot, worrying that rates could still go up and equities could still go lower in order for that to feed back weaker financial prices into lower inflation.
Particularly after the price action we've seen in the last week. Jack Caffrey, I know this is super, super frustrating, but Jack, is this equity market still at the mercy of what happens in bonds?
Well, certainly, the equity market has been tied at the hip by changing sentiment by bond traders, maybe more than bonds. Certainly the idea early in the year that we were going to possibly have seen rates peak and we'd actually get a recession wound up being really supportive of those secular growth stocks. I think the issue will come back for the equity market to how do we solve, if you will, the fixed income equivalent of the last mile? How do we get down from these presently high but much lower inflation rates than we've seen towards something more in line where the Fed can declare victory and perhaps round down to 2? And to some extent, the labor market isn't really giving them all the ingredients they need for that, particularly when you look at some of those high-profile contract negotiations where we recently had a president on a picket line, something that was, if you will, the end of the deregulation phase prompted by Reagan in the early 1980s. And I think that is going to be something that keeps the Fed also on guard to the extent labor wants to actually get paid right now.
I'll throw in another question. How should we characterize the bond market move we've seen over the last 2 weeks? Jim Karen, it's a big move. We're down from 5, we're back to 460 on a 10-year maturity. Are we confusing a bond market rally over the last 2 weeks with bond market stability?
I think that's a good way to phrase it. I mean, I see this more as bond market stability. I mean, look, the expectations is for growth to actually slow going forward. We've had a situation here where 3Q growth was very, very strong. 4Q is likely to be weaker. We may even get weaker growth in the first quarter. There's potential for there to be a mild slowdown or a recession in the first half of next year. So look, I mean, I think what bond yields are doing right now is they're finding that stable ground. Maybe it's between 4.5% and 5%. Maybe it's between 4.35 and 4.90. But I think we're in the zone right now, and I hate to call it Goldilocks, but if we do have stability in long-term interest rates, I think that does support other asset classes.
Jim, what is Goldilocks? HSBC says Goldilocks is back. You've just said it. What is it?
So, in my opinion, Goldilocks really starts to take the inflation risk off the table. Because, look, growth has been good. It's actually been disappointingly strong to many of the bears that are in the markets, right? I mean, the growth data has been decent. But what's been the big headwind has been that the Fed continues to threaten to hike interest rates and to slow growth even further. So if we get a cooling in growth, not a collapse in growth, but just a cooling down of growth, then that actually starts to reduce some of the inflation risk that's in the market. That actually takes the Fed hikes off the table, and we can allow the economy to start to recover in terms of earnings, in terms of, if it has a slowdown, has a mild recession, it can start to recover without the threat and the fear of the Fed hiking rates and taking the punch bowl away. That's what Goldilocks is.
Jack Caffrey, is that how you describe things?
Well, I think we're on the path towards Goldilocks, or maybe the path to the terrific twos that we saw in the years after the global financial crisis. But I think when we live in a world where implied fixed income vol, where we live in a world where 10, 15 basis point moves daily goes on the long end of the curve, this is going to carry through to the equity market. And so certainly last week, equities were very thrilled that we saw that falling in yields towards something more normal-like. But when we come back to this issue, we've had basically an economy that was relatively too strong against a lot of people's expectations, perhaps even too strong against the Fed's expectations. And that's forced this repricing towards how high do we have to go before it actually has an impact. And the history would suggest that the Fed tends to actually over-tighten. Now, the Fed, and Jim made this point about tightening of financial conditions, the second order financial conditions we do have to be mindful of is what's going on with lending officers, lending activity, where certainly credit is certainly becoming tighter. And at the same time, you're asking the banks to raise capital, which should result in even less lending. And so effectively, it might not be necessarily rates completely, but just overall credit availability in what winds up being a very credit-sensitive economy overall.
Jim mentioned Neil Kashkari, the Minneapolis Fed president. We caught up with him a little bit earlier. Take a listen to what he had to say.
We have to let the inflation data guide us, the labor market data guide us. You know, just to point out the obvious, our forecasts have not been great over the past couple of years. And so we just need to, we're all committed. Everybody on the FOMC is committed that 2% is our inflation target. We have to get inflation back down to 2% over a reasonable period of time. Ultimately, the economy will tell us how much is needed to get there. And I just don't know.
Mike McKee, great conversation this morning alongside you, sir. There's a man who's retaining that hawkish bias.
Well, he's retaining a hawkish bias, but he's making the same argument that pretty much everyone on the Fed is. We don't want necessarily to raise rates, but if we have to, we will. We just don't know. And you can see why in this chart here. Everything was going in the right direction, and then things have started to change. The CPI, which Kashkari pointed out had come in on a lower year-over-year basis, was up the last 2 months. And now we're seeing unemployment rise, which is supposed to happen, but look at the yellow line there. That's the Atlanta Fed GDP now. Now, not a lot of data in that yet, so it's not really representative, but you can see what direction it's pointing in terms of growth. So what's the Fed to make of all this? His point is, we've got to wait. We've got to see more data. It can't be just based on a very short-term decision. Now, whether we can get a decision from them on one way or another December 13th is an open question, but you can see what we've got coming up. We got 2 CPI reports and a PCE report and a jobs report. So there's a lot of data to come, and the markets may want certainty at the moment, but the Fed is going to wait and see what all those numbers tell them when they put them all together. And you can see here's what the Fed is dealing with, and what Kashkari is trying to push back on is the market now pricing for June the first rate cut, and you've almost got it priced in for May. So we'll see what the data say, but at this point, they say that last chart is wrong. The market is wrong, and we're not going to be cutting rates anytime that soon.
They wouldn't tell us even if they were. Mike McKee. And that's the nature of the conversation in financial markets right now. Jack Caffrey, earlier this morning, I asked Alicia Levine of BNY Mellon, about an hour ago actually, whether we've opened the door to a rally into year-end. She said yes. Jack, do you agree?
I would agree. You know, certainly seasonally, this has been historically a good time of year to be long equity markets. At least over the last week or two, the bond market has moved towards something somewhat more supportive. We certainly have had leadership from names that have worked on the year, and so there is a propensity to chase. And I would point that most tax selling is probably over at the institutional level. And with earnings winding down, you actually have the corporate bid coming back into the market for buyback. So you put all that together, I think the next 2 months could be, positive. Is that, low single digits, mid single digits? It would be certainly nice to hear from here. But I would say, the short term is more likely bullish than not.
Jack, away from the index, where do you want to be right now?
I think that this is a market where you probably are better served fading the tails. The more secular growth stocks effectively remain somewhat expensive. And to the extent that they are reliant on corporate decisions on how they reallocate capital or capital spending, I think that's going to be a little bit trickier if we start hearing more concerns of a slowdown. And at the same time, I think looking at very cyclical stocks is effectively asking if I can pick up a quarter in front of a steamroll. And I don't think the risk reward for taking that cyclical risk makes sense either. That leaves me to come back to looking durable growth. Companies that have some growth that are a little less economically sensitive, and I think have an ability to grow, even if not as quickly, if we do get that slowdown, hopefully that have been a little bit more restrained in some of their hiring plans, and importantly can return cash to shareholders in the form of higher dividends.
Jack, you've nailed the dilemma that I think so many people in this equity market are confronting right now. Jim Caron, if you want to buy at the moment and you're thinking about cyclicals, do you really want to be playing the recovery to the recession we haven't had yet?
Well, that's actually a really good way to put it. I mean, so you're absolutely right. I mean, like, many people want to buy value in this market right now, and I think value does make sense. But the issue with that is that we do need to see a recovery in the economy, so you need to see that recession and slow down first. So what I would argue is that we probably would still want to stick around the large cap growth story. We're going to follow the money. That's where the earnings are, and those are the areas that we think are actually going to do reasonably well going forward. We also like industrials, though. you know, I mean, maybe that you can kind of consider that as cyclical. I think we're going through a very big CapEx spend, and I think that sector of the market should do reasonably well.
Jim, Jack, stick with us. Let's turn to this price action. Equity futures on the S&P negative by 0.2%, about 20 minutes away from the opening bell. Let's get you some movers. Here's Kelly Greifeld.
Hey, John, well, I have 3 earnings stories for you. Let's start with Uber because it's been a dramatic morning in the pre-market after reporting earnings. Initially, shares actually sunk. They, of course, delivered a disappointing third-quarter sales number. The shares did get a lift after it delivered a rosy bookings outlook. As you can see, that didn't last long. Shares now down about 3%. TripAdvisor, totally different story, soaring after the online travel company beat on EPS and revenue alike. The only potential negative was the negative free cash flow reading. It's not holding back shares, though, up about 8.6%. I do want to talk about Datadog because absolutely flying after a beat and raise quarter for the cloud software company. They now see fourth quarter adjusted EPS between 42 cents to 44 cents. The estimate had been for 35 cents, so a big raise there. Barclays wrote that the outlook offers hope for better times ahead, and you can see that in the shares.
I always feel like that's a company that Tom Keene made up, Katie. Datadog. Katie, thank you very much. Coming up on this program, WeWork goes bankrupt.
Real estate, rental, and leasing, that industry is still impacted by the high interest rates.
From $47 billion to bankruptcy. That conversation up next.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one. Okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support because we are the best investment case for this in the world.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Estate, rental, and leasing, that industry is still impacted by the high interest rates, as well as when you're looking at construction, it's a mixed bag in construction as well. Commercial, not so much. Residential, still soft. So the interest rates are impacting those two industries.
WeWork, the latest commercial real estate casualty, filing for bankruptcy, listing nearly $19 billion of debts and entering into a restructuring agreement as it plans to streamline its rental portfolio. The CEO saying this: now is the time for us to pull the future forward by aggressively addressing our legacy leases and dramatically improving our balance sheet. The company, once valued at $47 billion at its peak in 2019. Claire Boston. Claire, what a turnaround.
That's right, John. This is absolutely wild. You know, a real story of value destruction from $47 billion to bankrupt in just 4 years. What we're seeing here is really going to be a story about pandemic and slow RTO trends. Ultimately, WeWork just had too many long-term leases, and the most effective way to cut those leases is generally bankruptcy.
Claire, do you think we've fully realized the consequences of going from 0 to 550 in the space of a couple of years in this equity market?
You know, I think WeWork is a real story of, you know, kind of timing the top right. Adam Neumann is out of the company and he got a big payday. And, you know, since then, it's really just been a story of downturn for WeWork. You know, they were hit really hard by the pandemics, the slow return to RTO, and rising interest rates are just really challenging in a market like CRE.
You wonder how much more pain there is still to come going into year end and into next year too. Claire Boston, thank you. Jim Kerr and Jack Caffrey back with us. Jim, let's build on this. Here you've got a company back in 2019, valued in private markets of $47 billion US. 4 years later, bankruptcy. Now, Claire alluded to it there. We can talk about the winner of ZERP, and maybe it was Adam Neumann. That's a conversation for another day. But Jim, do you think we've fully realized some of the pain associated with that move from 0 to 550 on Fed funds?
No. Not at all. I mean, I think this is an ongoing issue. So look, you know, we've talked about many companies, and some people refer to them as zombie companies that have really existed because capital is cheap, interest rates are low, they could borrow and they could debt finance for a long period of time. When rates are 5.5%, you know, your hurdle rate for investment and return on investment is a lot higher. So I think what we're seeing is the growth pains of these higher interest rates, where you're going to see more highly levered businesses that maybe weren't run as efficiently or didn't term out their debt as they needed to, are going to face a very, very stiff headwind. The other thing too is pricing power and margins. So one of the things that we like in this market are companies, this is why we like large cap growth, is because these are companies that typically have margin pricing power in their midst. Now, effectively, once we get into a situation where capital costs are higher, debt costs are higher, essentially what we end up seeing are many of these companies that just survived on low interest rates and cheap access to capital are just not going to be able to keep their margins up, and that's going to create issues on the equity side of their balance sheet. And that's effectively what's taking place. I don't think we've seen the end of it. I think this is what rate hikes are supposed to do. They're supposed to slow the economy, and that's exactly what's happening.
It's going to hurt more for some than others. So, Jim, let's put a light on some of it. I think we need to put a bigger light on all of it. Jim, what we had in the pandemic was the great financing of the United States of America on behalf of Treasury and the Federal Reserve. Who's going to suffer from the great refinancing in the next 12 months?
Well, look, I mean, I think we all do, right? You know, essentially, when we look at U.S. government debt and the amount that the government is borrowing and still needs to borrow in 2024 and onwards, this is going to create higher interest rates for everybody. So it's not that if we have a slowdown that I expect, you know, interest rates to rise into a slowdown. That's not what we're saying. What I am saying is that rates may not fall as much as they normally would or historically had. So typically when you get these big moves higher in interest rates, you end up getting lower rates at some other point later on, and then the economy can reset. What I'm saying is that it's going to be harder for rates to come down for a sustainable period and stay low, and that they're going to be likely to come back up relatively quickly. That's the hurdle. So it's not that we're in a big bear market in bonds or anything like that. It's just that we're going to cycle and that rates may not go down as much.
Another way of asking this question, Jack, is whether we've lost the Fed put in this market regime. I spoke to Ben Laidler of eToro a little bit early this morning. He thinks the Fed put is back. That's a really contrarian view. Jack, how do you think about that? Have we lost the Fed put in this regime?
I think it's very possible that we're going to see two versions of the Fed put. I agree with Jim's comment that the Fed will be slower to cut and will probably be, you know, assuming that they haven't achieved price stability anytime, their version of price stability anytime soon. What they do will probably be slower and less aggressive than they were in the aftermath of the global financial crisis. But the Fed does have a new weapon, which is to make more use of their balance sheet rather than the rate view. And if we come back to and think to when we had some funding issues with regional banks and suddenly the Fed is providing support to the banking system or to parts of the banking system and effectively guaranteeing deposits again, The Fed, I think, has decided that they have some new tools or new toys in their box, and that they might deploy different measures to use the Fed put. And that might actually be a little bit more surgical in terms of how they wind up deploying some of these new tools on a going forward basis.
Jim, would you echo that? Is that how you look at things?
Yeah, I think that's right. I think the Fed's going to have to become more creative. I mean, look, the monetary policy transmission mechanism, I think we can probably say, hasn't worked as efficiently as the Fed had thought that it would, meaning that they hiked interest rates, they figured that unemployment rates would rise and that they would slow wage inflation. That hasn't happened. And that's one of the big dilemmas in the markets right now, is just that the lagged effects of monetary policy, people keep saying that's going to bite at some point in time. Well, it may not. It may not bite as much as people think. I mean, yes, I think that rate hikes are going to matter, but I think some of the monetary policy transmission mechanism has been polluted to the extent that fiscal policy has taken on a bigger form of stimulus. So I think this is the dilemma that the market has to work through right now.
Jim Caron, wonderful thoughts as always, sir, alongside the brilliant Jack Caffrey. To the both of you gents, appreciate your time this morning. Going into the opening bell, about 7 or 8 minutes away. Here's the state of things currently. Your equity market totally unchanged on the S&P 500. 6 days of gains on the S&P, 7 on the Nasdaq. Into the bond market, we look a little something like this on Treasuries. Yields lower by 3 basis points on a 10-year, 461 on a 2-year, up about a basis point on a 2-year right now to about 494. Coming up, the morning calls and later, Laurie Calvasino of RBC weighing in on the equity rally after 6 consecutive days of gains, the longest daily winning streak going back to the summer. From New York City, this is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Minutes away from the opening bell on the S&P 500 right now. Equity futures, let's just call it unchanged after a stellar 6-day winning streak on the S&P, 7 on the Nasdaq. Over the previous 7 days on the Nasdaq 100, we've moved higher by more than 7%. That's the equity market story. Let's get to the bond market picture. 3-year notes coming to market a little bit later. So a test for the front end of the yield curve. At the moment, the 2-year higher by not even a basis point. At the moment, about 494 on a 10-year further out along the curve. Yields just a little bit lower by 3 basis points. Let's call it 461. That's the price action. Let's get you some morning calls. First up, Deutsche Bank downgrading Peloton to hold $4 price target, highlighting expensive valuation and limited visibility on growth. Your second call from Edward Jones upgrading HP to buy without a price target, expecting the PC market to return to growth next year. We're positive there by 1%. And finally, Bank of America downgrading Sonos to neutral, saying recent channel checks point to continued weakness in consumer electronics. We're down there by about 4.5%. Coming up, Morgan Stanley and JP Morgan pouring cold water on a year-end rally. That conversation up next with Laurie Calvasina of RBC Capital. Your opening bout is just around the corner.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the opening bout this morning. Good morning to you all at home. Equity futures right now on the S&P 500 totally unchanged. On the S&P 500, 6-day winning streak, the longest daily winning streak going back to the middle of June. Can we continue that streak? On the Nasdaq, we'll give it a go. On the Nasdaq right now, futures positive by 0.25%. Your opening bell rings in New York City. Switch up the board and get to the bond market. Yields look like this on a 10-year Treasury, down 3 basis points, 460.79. Some issuance through the next couple of days. 3-year notes later on this afternoon, $48 billion worth. 10-year notes tomorrow, $40 billion worth. The day after that, it's the turn of the 30-year maturity. 30-year bonds coming to market, $24 billion worth. Yields a little lower, the dollar still stronger, the euro negative by 0.5%, 106.70. And in the commodity market, a surprise of the last month, given the tension in the Middle East, to see crude back in the 70s. WTI, a break of 79 to the downside, 78.87. We're down here by 2.4%. About 30 seconds into the session, your equity market looks like this on the S&P 500. Totally unchanged on the Nasdaq, slightly positive. One stock to watch at the open is Uber, the company missing revenue estimates. The CEO saying this, our relentless focus on improving the product experience for both consumers and drivers continue to power profitable growth. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. Uber bouncing around, down more than 2 percentage points currently at the open. The street really focusing in on the bottom line. 9th straight quarter of EBITDA profitability, a record in the quarter gone, and from an adjusted EBITDA perspective. And then they're seizing on the outlook for the fiscal fourth quarter, where they say that gross bookings, which includes everything from ride-hailing, food delivery, and freight, will be between $36.5 and $37.5 billion, above street estimates. So too will adjusted EBITDA, which they're saying will be between $1.18 billion to $1.24 billion, again ahead of estimates. You mentioned the revenue miss in the quarter gone. What they accounted that for was a business model change and a cost registration change, which they say stems back to some business model changes in the 2020 fiscal year. That has impacted the revenue in the quarter just gone to the tune of $520 million or so. They like this name. We're looking now increasingly at GAAP profitability. That is often the case with these tech names. First, you get to EBITDA as a measure, then you go to GAAP profitability on operating income. But the story's kind of clear. They're continuing to grow the activity across their various businesses, and later on we'll hear from the CEO and ask how they're doing that, John.
Very cool. Ed, thank you. Looking forward to that a little bit later. Look out for that conversation. Ed Ludlow, Caroline Hyde on Bloomberg Technology. Let's get into the auto sector. Tesla raising the price of its Model Y in China following a style revamp in October. David Welch, you're the guy who's got to keep track of all of this, and I've got no idea how you do it.
Look, Tesla's trying to get some price increases after they've dropped them as much as 30% over the past year. And in China, they might be able to do it. The Model Y has been refreshed, so a bit of a newer product. It's one of the best-selling EVs. And also in China, you've got so many government incentives and programs pushing EV sales. It's not like in the U.S. where we're seeing this slowdown in sales growth and everybody's struggling to maintain price and maintain volume. It's more a matter of, they think they can get some of this pricing back because the market may let them do it.
David, we got this tentative deal between the Detroit 3 and the union UAW in the last couple of weeks. Given what things look like now for them versus Tesla, who's in the driving seat, so to speak, going forward from here to really attack that EV market?
Look, it's still Tesla. They had a cost advantage before all of this. They've got an even better one now because they're not giving 25% raises and other goodies over the next several years unless they're forced to by the labor markets. But even then, they probably won't catch up. And they've got the product on the market. They've got the brand. They pretty much have every advantage right now, and everybody is probably even further behind than they were 6 months ago in terms of catching up to Tesla in the EV business.
Tesla just about unchanged in early trading. David, thank you, sir. It's good to see you in New York as well. Just the broader price action at the moment. Just an update, 3 minutes into the session. That is an eighth, potentially day 8 of gains on the NASDAQ 100. Longest daily winning streak going back to November 2021. To equal that run, just looking at the Bloomberg right now, it would be 10 days. So right now, day 8 on the NASDAQ 100. Let's turn to earnings. TripAdvisor topping revenue estimates. The CEO saying the following: "We are pleased to deliver another quarter of healthy growth driven by our efforts to capitalize on our leadership position in the large and growing experiences category." Katie Greifeld on top of the story. Hey, Katie.
Hey, John. Yeah, TripAdvisor shares taking a bit of a victory lap this morning, and for good reason. You take a look at third quarter adjusted EPS. That came in at 52 cents. The estimate was for 46 cents. Revenue, like you mentioned, beat as well. $533 million. The estimate was for $505 million. Now, free cash flow, that was a negative $2 million. The estimate had been for a positive $52.4 million. Barclays writing that's likely to be the only disappointment in this print, but that management has, quote, successfully reset expectations and will regain credibility with this print. That has shares up currently about 7.5%. That's on track to be the best single-day performance since last August, and that's a needed boost for a stock that, coming into yesterday's close, was down 10% for the year, John.
Big time. Katie, thank you. Decent day of gains so far. Early days, though, the stock is up by about 7.7%. Let's turn to the home builders. D.R. Horton missing estimates as soaring mortgage rates weighed on demand. The company saying this: despite continued higher mortgage rates and inflationary pressures, we're well positioned to meet changing market conditions. Simone Foxman joins us now. Hey, Simone.
Hey, John. Yeah, the U.S. largest publicly traded home builder is actually higher so far in early trading, though, even though missing some of those numbers in the third quarter. And part of this is really because of its upbeat forecast. Forecast for 2024, putting that out for the first time, seeing revenue of 36 to 37 billion. Analysts had anticipated the lower end of that, 36 billion. Also seeing 86,000 to 89,000 homes closed in this coming full year versus versus the 86,000 that were anticipated. You mentioned again, though, the misses on some of those third quarter numbers, though. Purchase contracts, backlog lighter than expected, selling prices a little bit lower than anticipated. All of this really a result of these high interest rates that we have seen in the market, making it challenging for people to buy new homes. The company also issuing a bit of a warning on the call that margins in the first quarter may be lower than expected due to incentives. They've offered these massive buy downs on interest rates. Those play into marketing. Also downward pressure on prices anticipated. And the company is going to build some smaller, more affordable homes. Then again, the cancellation rate has come back down to pre-high interest rate hiking cycle levels at around 21%. There's just very little inventory, so homeowners have to buy this supply of new homes rather than the existing supply that's not out there. Maybe that's why we see these shares again up 1.2%. Remember, though, they gained 17% just last week.
We were talking about this with Neil Kashkari a little bit earlier this morning of the Minneapolis Federal Reserve. This is a big problem for the Federal Reserve, arguably for this country, access to the housing market. Simone, thank you for the update. We need to reset. We've had a massive week of gains on the S&P 500. We added to it just a little bit to start this week. We're pulling back now by 0.2%. Last week, best week of the year, a gain of more than 5%, close to 6 percentage points higher on the S&P 500, even more on the NASDAQ. Here's the pushback. 2 points, one from Morgan Stanley, the other from JP Morgan. Here's Mike Wilson at Morgan Stanley. The move thus far looks more like a bear market rally rather than the start of a sustained upswing. Here's the pushback from Marko Kolanovic over at JP Morgan. He thinks the gains will be short-lived. He writes the following: equities will soon revert back to an unattractive risk-reward as the Fed is set to remain higher for longer. We can have this conversation now with Laurie Calvasina of RBC Capital. Laurie, let's start there. The move over the last couple of weeks, do you believe it's warranted?
Sure. So, look, I think from a sentiment perspective, it absolutely is. If you look at what happened with the AAII survey last week, we really made an important move. We basically saw net bullishness return to 1 standard deviation below the long-term average. And if you looked at the weekly data point, it was actually 2 standard deviations below the long-term average. So what does all that mean? People got really, really pessimistic as yields surged, and it really reversed the excessive enthusiasm that we had seen develop in the equity market as of mid-August on that same survey. So we really saw sentiment finally worked down. And historically, stocks are very, very strong on a 12-month forward basis off of that. And that's not to say we don't still have a lot of risks out there. Of course, consumers and corporations are dealing with the impact of higher interest rates. But if you look at that pivot that we saw in 10-year yields as well, it really stopped out at an important level before we got to a level that is typically really problematic for equities. So, I'm not saying we're out of the woods entirely yet, but I do think this move has been a well-deserved sigh of relief.
Laurie, let's build on some of that. You spend a lot of time speaking to clients. When you speak to clients over the last couple of days, do you see them eager to chase this into year end? And a second part to that question, in addition to, is that sentiment at the whim of developments in the bond market on any given day?
So look, I think that your last point is a fair one. And I was actually on the road last week, so I wasn't sitting, by my terminal. I wasn't sitting by my computer watching all the, the red and the green on the screen. I was actually out talking to people. And what was really remarkable, John, is that I sense sort of an excitement that we haven't seen in a while. The last, I would say month or two, investors keep using the word stuck. They don't know what to do. They want to get set up for 2024. They've basically written 2023 off. It's been so bad in terms of relative performance, at least. And they've really wanted to start moving the chess pieces around for the year ahead, but they just haven't known what to do. And last week, people were saying, hey, what if bond yields have peaked? What should we buy? Should we be looking at small caps? What do you think about this move in the growth stocks? And there was a sense of relief that there was finally something to do. Now, I don't think that necessarily equates into kind of a stupid rally into year end, but I do think that the creative juices are being put to work again in a very, very healthy way.
Let's say yields have peaked. And I still think that's a difficult question to answer given the volatility we've seen over the last month. But let's assume they have. Let's game that out a little bit more, Laurie. What do you tell them they should do? Where should they be? Small caps have been beaten up. Financials have had a terrible year. Where should they be?
So look, let's take small caps. I think that's an easier call right now. And I'm certainly not saying, we're off to the races there. But we saw something else important happen last week, which that the unemployment rate ticked up. And that was one of the things that really seemed to capture people's attention from the jobs report. Historically, if you look pre-financial crisis, small caps really start to outperform around when that pivot in the unemployment rate happens. It's not always coincidence. Sometimes the U rate moves up first. Sometimes it moves up after the small cap pivot. But that really is an important milestone that that you tend to see. Remember, small caps bake in economic pain early. So if we're finally at that point where we're starting to realize some of this pain that's been anticipated and baked into this part of the market for so long, that typically gives people actually the courage to move back into this space. The other thing, John, and I talked about this with Lisa on Surveillance last week, is that small caps have really been battered from balance sheet concerns, and their balance sheets are not as bad as really as feared. They're not as bad as they've been in past cycles, and they typically also outperform once Fed rate cuts start to happen. So you've got another potential catalyst there on the horizon. So I think that's one place to look. I think it's a little trickier when you look at the growth sectors of the market. So typically consumer discretionary stocks outperform when yields come down. Also communication services stocks. Those are kind of two best bets in the S&P historically from a sector perspective if yield pressures come off. I would tell people to be selective between those two. Consumer discretionary still looks expensive to me, but I think you've got some decent valuations in communication services. So that to me would be the more natural place to nibble right now.
As we talk about the small caps, the Russell is down about 0.8%. Laurie, let's finish on the financials. I find it really, really difficult to establish a clear view with any clarity on the financials, and I'll tell you why. Yields are up all year. It's a problem for them. Then I think about reasons as to why yields might drop, and I think about an economic slowdown, and I ask myself, why would I want to own the banks in that situation? Laurie, it just feels like rock and a hard place for financial stocks. Is that what it is to you?
It is. And look, we've had an overweight, it hasn't worked. It frankly is something, we kind of stick with our process. Our analysts are constructive, valuations are compelling, and earnings revisions have been rebound. So all the data kind of tells you to go there, but it does break down a bit when you start to think about the why and you try to put that narrative together. My guess is that what's going on with financials is that we're in a bit of a regime change, that they're changing the function that they serve in the market. In the past, have they been cyclical? Yes. They haven't really been growth stocks per se, and I think there is a lot of concern about their ability to grow longer term. Do they sort of eventually morph into something more like the utilities sector where you collect a dividend yield and you don't get too much excitement? Maybe, we'll see. But I think that's really the problem with financials right now is I think they're kind of changing that function that they serve in the market.
Laurie, it's a difficult moment. It's a process, that's for sure. Laurie, great to catch up and get an update from you as always. Laurie Calvasina there of RBC Capital Markets. If you're just joining us about 13 minutes into the session, we're slightly negative. We're down 0.2% on the S&P 500, slightly positive on the NASDAQ. Coming up on this program, a shot in the arm for Governor DeSantis.
We need a president who has the skill and the resolve to reverse the madness that we see every single day.
That leader is Ron DeSantis.
The presidential hopeful getting a boost from Iowa ahead of tomorrow's Republican debate. That conversation up next.
Next week on AI IRL.
It's talent that drives, this innovation, and talent still concentrates around a small number of physical places. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities, but that is going to take 5 years or so. The export controls that the US has implemented, are real.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on, dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines, which make machines, to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
You can't be like some of these Republicans, many of them in Washington, D.C., that refuse to fight for our values. In Florida, and what Kim has done here in Iowa tells a different story.
We need a president who has the skill and the resolve to reverse the madness that we see every single day.
That leader is Ron DeSantis.
It's a shot in the arm for Florida's Ron DeSantis receiving a major endorsement from Iowa Governor Kim Reynolds, just as he was losing ground in the polls. The presidential hopeful now returning to Florida with fresh momentum ahead of tomorrow's Republican debate in Miami. Your team coverage starts right now with Bloomberg's Anne-Marie alongside Kelly Lyons in Washington, D.C. AMH, talk to us about the next 24 hours for the GOP.
Well, it's going to be a smaller, condensed stage, Jonathan, tomorrow in Miami, and all eyes are going to be on Governor Ron DeSantis. He's getting potentially a bit of a boost and some love from the governor of Iowa. That endorsement is critical for him. He spent a lot of money and capital in Iowa. He's almost visited every single district in Iowa, which was part of his strategy. But a recent poll by NBC and Des Moines Register also showed that Nikki Haley has caught up to him in Iowa. So all eyes are going to be on these two frontrunners as they take the stage tomorrow. But amongst all of this, Jonathan, poll after poll continues to show the former President Donald Trump is out racing all of them.
A commanding lead. Nikki Haley getting a bit of momentum in the last couple of weeks. Kelly Lyons, it's election day, 12 months from the big one next year.
Yeah, John, usually we don't pay that much attention to off-year elections because they aren't just all that exciting, but these could, this day in particular, send really important signals for 2024. There's a number of key races that we're watching here in Washington, one of them being in Ohio, Issue 1. This is literally abortion on the ballot. We have seen post the fall of Roe versus Wade that abortion is a real turnout driver, especially in special elections in which abortion rights advocates have notched a lot of victories. And once again, if this is indeed cementing abortion rights into the constitution of what is more and more a red state, it could be a pretty big signal about what's going to drive turnout in the wider election in 2024. Abortion also an issue just across the river from us in Virginia, where both the House of Delegates and State Senate are entirely up for grabs. And this is a real big test for the Republican governor, Glenn Youngkin. He is trying to cement control of the entire state legislature by flipping the Senate from the Democrats and retaining control of the House. Whether or not that effort is successful, it could be a pretty big bellwether for 2024 because Virginia is a purple state. And of course, if he does indeed have success in getting more Republicans into the Virginia legislature, he could ride that momentum potentially. There's a lot of murmurs about a presidential run of his own. And then finally, the other one to watch, Kentucky gubernatorial race, in which the Democratic incumbent Andy Beshear is in a really tight race with his Republican challenger, who is trying to make this about national issues and tying President Biden to Beshear. And it's going to be a real tell as to how problematic a relatively unpopular Democratic president is for Democratic incumbents in their elections that they're facing.
AMH, we cannot get away from this, can we? The prospect of the sitting president dropping out and the prospect of Governor Glenn Youngkin jumping in.
We can't. We cannot get away from this because, one, poll after poll continues to show that the Republican people think that President Biden is too old. But also, Jonathan, they also don't want to see a former President Trump. When you look at national polls, and we have a story about that in Business Week. But then when it comes to Glenn Youngkin in particular, the donors are courting him. They are desperate for him to jump in. But for him, Jonathan, he has till 2026 of this term to be governor, and then he basically cannot run again due to a consecutive term he cannot run for due to Virginia election laws. So this matches up perfectly for him timing-wise. If he is able to flip Virginia red, he will then show that he was able to have this huge red wave in Virginia, lead as a conservative governor, and then 2 years before the next presidential election.
Fascinating
But
time.
many are hoping he can get in now, but it would be very dicey for him at this moment, some say.
AMH, appreciate the update. Alongside Kelly Lyons down in Washington, the two of you, just fantastic, as always. We're about 21 minutes into the session. Let's go through the price action for you. The scores look like this on the S&P 500. Totally unchanged, really. We're down by not even 0.1% on the S&P. On the NASDAQ 100, positive by 0.3%. That's day 8. 8 days of gains on the NASDAQ 100. Incredible run so far over the last week or so. Let's get you some sector price action. We can do that with Bloomberg's Kelly Greifeld.
Hey, well, there's a little bit more action under the hood of the S&P 500 right now, pretty much unchanged on the day, but you have 4 sectors in the green, 7 in the red. You look at what's leading right now. Consumer discretionary having a good day, so too is tech, but we're talking about pretty small moves here. I don't know what's going on with materials. Maybe we can check that out later, but you take a look at the bottom there. You can see real estate down, industrials down 0.6%, and energy really having a tough run of it, now down another 2.3%, really adding up to some of the pain. But one sector, one industry group that's having a good day today, of course, is infrastructure software. Of course, we got those earnings out of Datadog, out of Terex. That sector up about almost 15% year to date. A little bit of outperformance, but you compare that still to the NASDAQ 100, still lagging, John.
Katie, thank you. Up next on the program, I'll get you a sneak peek of the next week or so in the trading diary. And I can tell you within that trading diary, the Treasury this week is going to be issuing a lot of debt on a 3-year maturity, a 10-year, and a 30-year. I'll bring you the numbers up next from New York. This is Bloomberg.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Discussion amongst me and any of my colleagues about when we're going to start preparing to cut rates. The only thing that's been talked about at all is that at some point, when inflation is well on its way back down, if we didn't back off a little bit, then real rates would be getting tighter and tighter and tighter.
And you know what happens? Everyone starts talking about cutting interest rates. That was Neil Kashkari of the Minneapolis Federal Reserve. Great conversation a little bit earlier on this morning. For the equity market, about 25 minutes into the session on the S&P 500, totally unchanged after 6 days of gains. On the NASDAQ, it's day 8, the longest daily winning streak on the NASDAQ 100 going back to November 2021. That's the price action for equities. Let's get to the trading diary. Here's the week ahead, and a big week at that with tons of Fed speak. Governor Chris Waller speaks at the top of the hour. More Fed speak throughout the day from Williams and Logan. Then we get some Treasury supply. $48 billion of 3-year notes at 1 p.m. Eastern, $40 billion of 10-year notes on Wednesday, $24 billion of 30-year bonds on Thursday. A little bit more to look out for on Wednesday. Disney reporting after the closing bell, and Fed speak continues with Cook, Barr, Jefferson, and the big one, Chairman Powell, a little bit later this week. From New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power.
We're going to make more money. We're going to make more money. And we're going to make more money.
We're going to make them bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John
Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, after a 6-day rally, the major stock averages, they're mixed to little change right now. The biggest drag in the S&P 500, that belongs to energy. Oil falling below $80 a barrel for the first time in more than 2 months. Investors seem to be waiting for the next round of major catalysts for the markets. You heard Fed Bank of Minneapolis President Neil Kashkari telling Mike McKee he isn't ruling out more hikes. Right now, the benchmark 10-year yield, that is 4 basis points lower. We're at 4.59, the 2-year unchanged at 4.94. As for the markets, Alicia Levine is head of investment strategy at Bank of New York Mellon. She says the door is open to a year-end stock rally.
There's clearly a market clearing price in the 10-year, and that's a little bit above 5%, and that's essentially, I think, where our ceiling is here. And you've seen trying to get above 5% comes down, bats down again. That's the market clearing price. With that knowledge, you set up into a year-end rally.
And again, the S&P 500 up just 3 right now, 43.69 on the index. The Dow up just 4 points, 34,099. And right now, the NASDAQ 100, 80 points higher. That is up 0.5%. And let's do an earnings scorecard for the S&P 500. You had 424 of the 500 companies reporting so far this earnings season. And of those, we had 82% delivering earnings surprises. And Elon Musk company, Neuralink, seeking a volunteer for its first clinical trial, looking for somebody willing to have a chunk of their skull removed by a surgeon so a large robot can insert a series of electrodes and super thin wires into their brain. Any volunteers? We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
Markets for a long time, spending a quarter of a century on Wall Street at the likes of Deutsche Bank, Prudential Securities, and E.F. Hutton. He's so well known to the Bloomberg audience, an investment strategist, former Fed economist. His market analysis as president and founder of Yardeni Research, followed by so many, including all of us at Bloomberg. And he did coin the phrase bond vigilante some 40 years ago to describe those investors who sought out to enforce fiscal discipline by driving up government borrowing costs. He is joining us on Zoom in New York City. Ed, it is so great to have you back with us, so timely. Talk to us about this environment. You wrote back in early October about the vigilantes being back. Is it similar to what we've seen before, something different? Give us some perspective.
Well, I think the last time we really had a lot of activity from the bond vigilantes was basically back in the 1980s. We had just had this terrible inflation event in the 1970s. It was fondly called by some of us the Great Inflation, which actually started in the mid-60s when President Johnson ran a war in Vietnam with large deficits. So we had guns and butter back then, and Nixon came in, continued that policy. The dollar declined rather substantially when he took us off of gold. And there were a lot of events that occurred in the 70s that led to inflation. And the bond investors really got left high and dry. They took substantial capital losses in the bonds. So by the 1980s, they figured it out that they had to maintain some law and order in the financial markets if fiscal and monetary policies weren't going to do it. And so we had I think about 3 episodes in the 1980s where bond yields rose, worrying about inflation, and the economy slowed and inflation came down. So they were very effective in maintaining law and order in the 1980s. By the 1990s, their message had gotten across to Washington, and the Clinton administration was actually fairly conservative in its fiscal policies because of their concerns that the bond market was watching them. And so we saw that the bond market didn't really have to do much. The bond vigilantes kind of went to sleep there for a while. And then inflation came down for all sorts of reasons, including globalization and technological innovations and so on. And so we really didn't hear from them until 2010, when I got a call from one of your reporters, I think at Bloomberg, said, are the bond vigilantes in Greece now because the bond yield was soared to 40% in in Greece at that time. And then the next episode where the bond vigilantes became relevant, I think, has been this past year, especially since the summer, when the bond yield went up from 4% to 5%, without really being attributable that much to what the Fed was doing. It was more because there was just a realization that the federal deficit was out of control. And so they came back. Now I've been getting a lot of calls. It's like, well, what happened last week? Where are the bond vigilantes? Are there no more issues with debt and the deficit? And of course,
where are they? What did happen last week? Where are they?
Well, I think that last week demonstrates that the bond market's got a lot of moving parts. The bond vigilantes aren't the only players. As we know, during the great repression of bond yields, the new abnormal from the great financial crisis to the great virus crisis, bond yields were very close to zero, along with other interest rates, because the central bank kind of took over. But inflation wasn't a problem. So I think now we have to recognize that there were a lot of hedge funds that were playing the bond vigilante game and shorted the living daylights out of the bond market. And then we had some data and some news from the Fed last week that suddenly made those shorts realize they were on the wrong side of that bet, and they all panicked at the same time. So it's there's a lot going on in that bond market. It's not just the bond vigilantes, but we know the debt problem hasn't gone away, the deficit problem hasn't gone away, and they'll be back, as Arnold Schwarzenegger once famously said.
So, what do you think then, Ed, that means for the 10-year? I mean, is that the yield to watch right now, or is there a certain part of the curve that you think is more susceptible? It feels like we were evening out 5%. You know, go back, a month or so ago, I feel like people were talking 6%. What do you think is realistic when it comes to where rates peak out? Or do we not kind of yet know yet?
Yeah. Well, it is sort of learning by doing. We haven't had this kind of environment where the debt was this large and where we have the compounding of that debt because interest rates have gone up, and now the fastest growing component of federal outlays is actually net interest. It's growing faster than anything, Social Security, Medicare, defense, and so it's become a real worry. And look, supply and demand in the bond market never seemed to be that important. It seemed to be more inflation and what the Fed was going to do about inflation. Supply used to be a problem, if you will, during recessions, and therefore it wasn't a problem because during recessions, interest rates would go down, inflation would moderate, and there was plenty of demand for the supply of bonds. We've never had a situation where we've got a record deficit when the economy is doing obviously quite well, and we have an inflation problem, which seems to be moderating, but there's still some controversy about all that. So yeah, I think the 10-year is the number to watch. That the stock market is definitely keyed off of that. I would think that at this point we're going to have a very wide range. I think 5% might mark the top of the range for a while. And I think 4% or 4.25% might mark the bottom of the range. I think between now and year end, it's going to be even tighter than that. It'll probably be 5 to 4.5%. I think we'll trade in that kind of range. And the stock market should welcome that. We just need some stability in the bond market in order for the stock market to resume its move to the upside, in my opinion.
Well, that's what I want to ask you, because the move up that we saw in the stock market last week, you thought that was justified, made sense in terms of where rates are, or that maybe because rates are kind of peaking out at this point, that it makes sense for even the equity market to rally even further, that it makes sense in terms of the interest rate environment and fundamentally?
Well, everything depends on one's view of what's next, what's going to happen in 2024. I've been relatively optimistic about the resilience of the U.S. economy since early last year. Actually, I was one of the early ones to say, hey, we're actually in a recession. It's just a rolling recession. It's impacting different industries at different times. And overall, it's not adding up to an economy-wide recession. And so the economy's resilience, I think, has been proven since then. There's still what I call the die-hard hardlanders, who think that the recession is still coming and it's coming in 2024, but eventually they're going to be right. It didn't happen in 2022. It didn't happen in 2023. It could happen in 2024. I put the odds at something like 35% of that. I just want to show that I'm reasonably open to the possibility that they could be right. But my view is that the economy is going to remain resilient going into next year. And if that's the case, earnings should continue to improve. You know, when the numbers all come in for the third quarter, I think they're going to add up to record earnings for the S&P 500. You wouldn't know it by all the pessimism coming out of some of the hardlanders, particularly on Wall Street. But I think earnings will drive the market higher next year. And I think valuation multiples for the overall market stay high simply because there's something that we have to deal with as the new reality here. And that is it may very well continue to be that a handful of stocks, I call them the mega cap 8, people call them the Magnificent 7. I like Netflix, so I throw them into the mix. And I think that they're going to continue to be highly valued and have multiples of 25 to 30. So the overall valuation for the market may very well be 18 to 20.
Okay. What about when we get back to the 10-year and thinking about long-term, where you see yields? You talked about the range of the 10-year this year and for the remainder of the year. But thinking long-term, I mean, is the era of a 10-year that provides mortgages, gets mortgages, a sub 3%, is that era over forever?
Well, everything is relative. We had what I call the new abnormal period between the great financial crisis, 2008, to the great virus crisis, 2020-21. And during that period, lest we forget, central banks were obsessed with deflation and were trying to desperately get the inflation rate up to 2%. Beware of what you wish for, because once the pandemic hit and once they just flooded the system with money, and fiscal authorities came in with the helicopter money, dropping checks into people's deposits, we got this wicked surge in inflation, which at first everybody thought was persistent, then transitory, then everybody thought was persistent. Now I think the evidence is suggesting that it's actually pretty transitory. Not only have I been an optimist on the economy, I'm optimistic that inflation is coming down, and I think it could actually come down to 2%. And the key to my optimism is I think productivity is making a comeback. Productivity is the magic variable that can make a lot of things better and much better than the naysayers have been saying. And if that's the case, productivity can bring inflation down, can allow wages to rise faster than prices, and can obviously be stimulative for economic growth. So in that world, we're going back to where we were before that new abnormal period, before the great financial crisis. Back then, the bond yield was 4 to 5%, and the economy could live with it without a problem. And I think we're back to that kind of scenario.
Ed, remember when Alan Greenspan, I feel like every testimony he gave, he would talk about the productivity gains and the advantages that gave to the U.S. economy. Right. Having said that, there's a lot of naysayers out there. Jamie Dimon, World Bank president, talking about this dangerous juncture that we are at for the global economy. Larry Fink of BlackRock talks about less hope and a lot more fear. They are pointing to geopolitical. How does that factor in to your thinking about U.S. financial markets?
Well, just as an aside, I don't know what it is about being a billionaire, but all the billionaires at the banks and at the hedge funds are all warning us of all sorts of dire things. And they're right. There's a lot of things that are going wrong right now in the geopolitical area. And yet look at the price of oil. With a horrible war going on in the Middle East, the price of oil is actually going down. I think that what's going on a global basis is China's economy is weak, Europe's economy is weak, our economy is relatively strong, but it adds up to kind of a muddling along a global economy, and that's not really boosting commodity prices at all, which is good for us in terms of keeping inflation down. I think the Saudis learned a lesson this summer that the world's not going to be able to handle $100 oil, and something in the neighborhood of $80 is more sustainable. If Iran's oil production or oil exports get stymied by the reimposition of much tougher sanctions on their oil exports, the Saudis will produce more. So that geopolitical issue is one that the market seems to be learning to live with, as it's learned to live with the issue of Russia's invasion of Ukraine. So yeah, we got terrible problems out there, and horrible situations where people are getting killed. But the stock market looks at the global economy and concludes that it'll continue to grow, mostly because of the resilience of the U.S. economy. And so that leads me to conclude you want to overweight the U.S. in global portfolios.
So let's talk about that. In the U.S. market specifically, Ed, in terms of the equity side, where would you be committing money at this point?
Technology, energy, and financials. Technology's worked out pretty well for me. Financials are starting to work out pretty well. Energy, not so much right now. But I think that, the world is going to continue to be dependent on fossil fuels, and the fossil fuel companies have reduced their capital spending because of pressure from the climate activists. So they're actually going to continue to generate some very strong cash flow. They'll do buybacks, they'll pay out dividends. So they work. Financials, as we saw last week, had a tremendous rally on the perception that maybe the Fed's done, and if it's done and we haven't had a recession, then they should do relatively well. And IT is all the reasons that we all are familiar with. There's tremendous technologies out there to deal with it, to solve a problem we have on a global basis, and that's a real shortage of labor. And that's where the productivity story comes in. I think technology will be used to increase the productivity of labor.
All right, I know you're a stocks guy, Ed, but when the yield's at the 10-year at 4.6% right now, got to ask you just in the last 30 seconds, where you'd put money in fixed income right now?
Well, I think that you put it in the 10-year. There's nothing wrong with the 10-year yielding 4.6%. Maybe you'll regret not buying it at 5% yield if we have another opportunity like that, which I presume we will. But yes, I think the bonds, generally speaking, offer good yields right now relative to my inflation outlook.
Ed Yardeni, 15 seconds. Too early to start talking about the Fed cutting rates, which the market seemed to get pretty excited about, I think, last week. Is it too early?
Well, if the market's thinking they're going to cut rates because of recession, that's not my scenario. If they're expecting the Fed to cut rates because inflation is going to moderate and we don't need to have rates quite this high, it's possible. Right now, I would go with the Fed's official forecast of 2 rate cuts instead of 4 rate cuts next year.
All right, we're going to leave it there. That is Ed Yardeni, president and founder of Yardeni Research. Thank you so much. All right, let's get a check on company news with Steve Rappaport.
Good morning. WeWork has filed for bankruptcy. Let's get the latest on that from Bloomberg's Charlie Pellet.
Steve, the filing caps an epic downfall for a company once valued at $47 billion. WeWork listed $19 billion in liabilities and $15 billion in assets in its bankruptcy petition. The Chapter 11 filing allows WeWork to continue operating while working out creditor repayment terms. The shared workspace company entered bankruptcy after reaching a tentative restructuring deal with longtime backer SoftBank Group and existing creditors to slash over $3 billion of debt and wipe out most of its shares. It's also seeking to reject more than 60 leases across North America and will use the court process to renegotiate other contracts.
Steve? Thanks, Charlie. Uber stock is down despite an upbeat forecast for bookings and profit. Let's get more from Bloomberg's Jeff Bellinger.
Steve, Uber says total gross bookings, including ride-hailing, food delivery, and freight, are projected to be $36.5 billion to $37.5 billion in the fourth quarter. That topped analyst estimates, but third-quarter revenue still fell short of expectations. Uber attributed the slowing growth rate to accounting changes. The company still dominates the U.S. ride-hailing market with a 74% share. Rival Lyft, which reports earnings tomorrow, has the other 26%, according to data from Bloomberg. Steve?
I'm Steve Rappaport, and this
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, green on the screen. Not a lot of movement, though. Minneapolis Fed President Neil Kashkari, he reminded markets this morning there haven't been any discussions about interest rate cuts just yet at the Federal Open Market Committee. Risk assets, again, mixed a little change. Volume about 12% below its 30-day average at this time of day for the S&P 500. You have materials, the best performing industry group in the index. Energy, the biggest drag, is crude oil drops right now over 2%. We have NYMEX crude, that is below $80 a barrel. Right now, the S&P 500 2 points higher at 4368. The Dow Jones Industrial Average 2 points lower at 34,093. And the NASDAQ 178 points higher. That's up 0.5%. And we have the 10-year yield 4 basis points lower at 460. The 2-year is unchanged at 493. You know, the annual interest payment on the national debt has reached eye-watering levels. This is a Bloomberg analysis shows that it's now topping $1 trillion, and that amount has doubled in the past 19 months. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Carol and Tim.
What's the matter?
I guess that's what happens when rates go up. You know, you kind of have to
That's
pay
what
more
happens.
on money you borrow.
Stupidly,
I don't know.
somebody that you know and love also took out a variable interest rate loan. So, and that person's paying on too.
Wait, are you talking about the government?
The government on one.
I know and love, is that John Tucker?
Yeah, that was so.
Okay, well,
gotta pay that off soon.
You know, spend.
And the bond vigilantes are after me.
All right. They're knocking at your door.
Gotta run faster, John.
All right, John Tucker, thank you so much. John Tucker back at Bloomberg headquarters in New York City. We are, of course, in New Orleans. We're going to get back to our summit here, sponsored by Wells Fargo, in just a moment. But I got to say, reading in this morning, this column for me explained so much about the situation, the reality of Palestinians in Gaza. It is written by Bobby Ghosh, who has become a go-to for us throughout this conflict, this war, a Bloomberg opinion columnist covering culture, but he covered foreign affairs for so long, including the Middle East. And he writes in this column today about the terror group that maintains a monopoly on power over the Strip, Gaza Strip, and controls its economy, and why Hamas has never faced a serious uprising from within their Gazan area, like from the Gazans, I should say. So Bobby joins us back in our Bloomberg Interactive Broker studio. I will say, Bobby, that I feel like understanding what is going on in the region, you really have to understand kind of the situation for Palestinians living in the Gaza Strip. Tell us about what you wrote about and why you think it's important to share this with folks.
Yeah, thanks for the opportunity, guys. So basically, ever since this conflict started, this latest iteration of the conflict, a lot of people have been asking me, have been asking in general, why don't the Palestinians get rid of Hamas? If we all agree Hamas is bad, we also keep saying that Palestinians are not the same thing as Hamas, and that in fact there's some anecdotal and some polling to suggest